You need to be able to buy just one fund and own it till your dying day. Any asset allocation crap should be handled for you. You have bridges to build, nations to run, great art to create, diseases to cure, businesses to build, beaches to sit on. I'm here for you, Bunky. More importantly, Vanguard is as well, with a series of 12 TRFs, target retirement funds. For that matter, so are other mutual fund companies, but as you know, Vanguard is the primo choice around these parts, so we'll be talking about their TRFs. If your 401k or similar plan offers only one of the others, what is said here, accepting expense ratio costs, still applies. If you visit www.vanguard.com, you'll see that these 12 funds range from Target Retirement 2010 to Target Retirement 2060, plus one for those already in retirement at age 72 and above. The idea is that you simply pick the year you plan to retire and find the appropriate fund. Other than adding as much as you can to it over the years and arranging for withdrawal payments when the time comes, there is nothing else you need ever do. It's a beautiful and elegant solution. Let's peek under the hood. Each of these target retirement funds is what is known as a fund of funds. This just means that the fund holds several other funds, each with different investment objectives. In the case of Vanguard, the funds held are all low-cost index funds. As you know by now, that's a very good thing. The TRFs ranging from 2020 to 2060 each hold only 4 funds. Total Stock Market Index Fund, Total Bond Market Index Fund, Total International Stock Market Index Fund, Total International Bond Market Index Fund. To those 4 funds the TR 2010, 2015 and 2020 funds add Short-Term Inflation Protected Securities Index Fund. As the years roll by and the retirement date chosen approaches, the funds will automatically adjust the balance held, becoming steadily more conservative and less volatile over time. You needn't do a thing. The expense ratios range from 0.14% to 0.16%, depending on the fund. Not quite as low as a basic index fund like VTSAX, 0.05%, but very good considering the extra simplicity these offer. What are the shortcomings? Some people say the funds get too conservative too soon. Others complain that they are too aggressive for too long. For my money, I think Vanguard gets it pretty close to spot on. Maybe a bit conservative for me personally, but then I'm on the aggressive side. This is easy to adjust for. If you want a more conservative, greater percentage of bonds approach, choose a date before your actual retirement. The earlier the date, the more conservative the asset allocation. If you want more aggressive, greater percentage of stocks, just pick a later date. Other fund companies use differing allocations for different retirement dates. If those are what's offered in your 401k or 403b plan, you'll need to take a look and decide accordingly. But the same principles apply. Given these benefits and relatively low costs, I am comfortable recommending TRFs. They are an excellent choice for many, maybe even most people. They will certainly outperform the vast majority of active management investment strategies over time. But I do have a slight preference for the approaches described in the earlier chapters. Here's why. The expense ratios are even lower than those of the TRFs. The TRFs all hold the Total International Stock Market Index Fund. While this is an excellent fund, as we discussed in Chapter 15, I don't feel the need for additional international coverage beyond that found in the Total Stock Market Index Fund, VTSAX. With separate funds, I can keep my bonds in my tax-advantaged bucket, protecting the dividends and interest from taxes. If you decide to own TRFs, they too are best held in a tax-advantaged bucket. Where are you likely to find target retirement funds? Target retirement funds have become very popular as options in the 401k and 403b retirement plans offered by employers. The idea is most people really have very little interest in investing. Overall, this is sound thinking, and TRFs provide an effective, simple and well-balanced, one-decision, solution. Plus, because such retirement plans are tax-sheltered, the interest from the bonds and the dividends from the stocks go untaxed. Of course, other than those held in Roth 401k or Roth IRA accounts, when money is withdrawn in retirement, taxes will be due. What should you do? If your company's retirement plan offers TRFs from Vanguard or low-cost equivalents from another fund company, they are well worth your consideration. If you want a portfolio that's as simple as possible and still effective, TRFs are for you. They have the simple path to wealth stamp of approval. Chapter 17. What if you can't buy VTSAX? Or even Vanguard? Throughout this book I've recommended two specific mutual funds. VTSAX, Vanguard Total Stock Market Index Fund, VBTLX, Vanguard Total Bond Market Index Fund. These are the funds I own myself. In each case they are the Admiral shares version of those portfolios. As such they have rock-bottom expense ratios, but also require a minimum investment of $10,000. While these Admiral shares versions best fit my needs, they might not fit yours. Perhaps you are just starting out and the $10,000 minimum is still too steep. Or maybe they are not offered in your 401k plan. Vanguard is also the only investment company I recommend or use, and we'll explore why in the following chapter. But maybe Vanguard itself is hard to access in the country where you live or in the 401k you are offered. Not to worry. In this chapter we'll explore some alternatives. Variations on the funds. The first thing to understand is that VTSAX or VBTLX are each only one fund that holds the total stock market index and total bond market index portfolios, respectively. It is the portfolios that matter, and Vanguard offers each in other flavors. For example, the exact same portfolio held by VTSAX can be found in 6 other funds, or what Vanguard calls classes. Below I list them followed by their expense ratios and required minimum investment. The first 3 are for us individual investors. Admiral shares, VTSAX 0.05% $10,000 investor shares, VTSMX 0.17% $3,000 ETF, VTI 0.05%, ETF equals exchange traded fund. You can buy ETFs in any amount you want, just like a stock. Note the expense ratio is just 0.05%, the same as that of the Admiral shares. For this reason some people prefer to buy the ETF rather than the investor shares fund. Makes sense, but be careful. When buying or selling ETFs, just like a stock, commissions and/or spreads are frequently involved. These added costs can offset the savings in the expense ratio unless you have access to free trading. These next 3 are institutional shares, and you might find them in your 401k or other employer-sponsored retirement plan. VIX, 0.02% $200,000 VIX, 0.04% $100,000 VITS, 0.04% $5,000,000. So, when I recommend VTSAX you can substitute any of these if that's what is available and or if one of the others better meets your needs. The important thing is that you are buying the Vanguard Total Stock Market Index portfolio. Similar variations can be found for VBTLX and its Total Bond Market Index portfolio. If you visit www.vanguard.com and search for VBTLX, you'll find the home page for the fund. At the very top, under the fund name, you'll find links to the investor and ETF versions. When Vanguard isn't an option in your employer's tax-advantaged plan. Vanguard has a very active institutional business serving 401k programs and the like. But it very well may not be a part of yours. However, even if your tax-advantaged, employer-offered plan doesn't offer Vanguard, you should still participate, certainly at least up to the amount needed to capture any employer match. Once you leave that employer, you can easily roll your investments into an IRA with Vanguard. So without Vanguard in your plan, the question becomes how to select the best option, which by now you know is a low-cost total stock and/or bond index fund. The good news is that, due to the competitive pressure from Vanguard, nearly every other major mutual fund company now offers low-cost index funds. Just like the variations you can find in Vanguard of VTSAX, you can in all probability find a reasonable alternative in your 401k. Here's what you are looking for. A low-cost index fund. For tax-advantaged funds you'll be holding for decades, I slightly prefer a total stock market index fund, but an S&P 500 index fund is just fine. You can also look for a total bond market index fund if your needs or preferences call for it. Most plans will also offer these. TRFs, target retirement funds, are frequently offered in 401k plans, and these can be an excellent choice. But look closely at the fees. They are always higher than those for index funds, sometimes by a lot. For instance, the TRFs from Vanguard have expense ratios ranging from 0.14% to 0.16%, as compared to 0.05% for VTSAX. Those from other firms can run 5-6x higher. For my international readers. If you live outside the US, Vanguard and its funds may or may not be available. Vanguard is growing rapidly and is now available in many countries outside the US. You can check out the list at www.global.vanguard.com www.global.vanguard.com. If Vanguard simply is not an option, in your fund search you'll want to follow the same guidelines as described above for tax-advantaged plans. Also, when I talk about VTSAX or any total stock market index fund, these are indexes that mirror the US stock market. As I explained in Chapter 15, this is all those of us in the US really need. But you might find it difficult to access such a US-centric fund. No worries. Take a look at a global fund like VTWSX, Vanguard Total World Stock Index. This is an index fund that invests all over the globe. In some ways I like it even better than my beloved VTSAX. I don't recommend it instead only because of its relatively steep expense ratio. 0.25%, and because VTSAX covers international pretty well for the reasons I describe in Chapter 15. If you are inclined to go this route, you might consider the lower-cost ETF version, VT, Vanguard Total World Stock ETF. Ordinarily, I tend to avoid ETFs, exchange-traded funds, because of the possibility of sales commissions and/or spreads. But since the expense ratio on VT is 0.14% versus 0.25%, it is worth exploring. Just be careful of the trading costs when you buy it. One final caution. Be sure that whatever global fund you choose includes the US market. It is a huge chunk of the world economy and you can't afford not to own a part of it. Many international funds, especially those offered by US-based firms like Vanguard, are ex-US stocks, meaning they do not include US-based stocks. The reason is that they are designed to supplement the holdings of investors already in the US market with VTSAX and the like. Makes sense, but likely doesn't suit your needs as an investor outside the US. The bottom line. If I didn't have access to those two specific funds, VTSAX and VBTLX, or to the even lower expense ratio institutional versions, I'd look for the Vanguard variations that delivered the same Vanguard stock and bond index portfolios. If I didn't have access to Vanguard, I'd look for similar low-cost funds from whatever sound investment company was available. And if the future offered me the chance, I'd roll my holdings into Vanguard when I could. Chapter 18. What is it about Vanguard anyway? If you've read this far, you know I am a strong proponent of investing in Vanguard index funds. Indeed, unless you have no choice, as discussed in Chapter 17, my strong suggestion is that you deal only with Vanguard. Understandably, such a bold recommendation is going to raise some questions. In this chapter we'll address the four most common. 1. What makes Vanguard so special? When Jack Bogle founded Vanguard in 1975, he did so with a structure that remains unique in the investment world. Vanguard is client-owned and it is operated at cost. Sounds good, but what does it actually mean? As an investor in Vanguard funds, your interest and that of Vanguard are precisely the same. The reason is simple. The Vanguard funds, and by extension the investors in those funds, are the owners of Vanguard. By way of contrast, every other investment company has two masters to serve, the company owners and the investors in their funds. The needs of each are not always, or even commonly, aligned. To understand the difference, let's look at how other investment companies, most companies, in fact, are structured. Basically, there are two options. They can be owned privately, as in a family business. Fidelity Investments is an example. They can be publicly traded and owned by shareholders. T. Rowe Price is an example. In both cases the owners understandably expect a return on their investment. This return comes from the profits each company generates in operating its individual mutual funds. The profits are what's left over after the costs of operating the funds are accounted for, things like salaries, rent, supplies and the like. Serving the shareholders in their mutual funds is simply a means to generate this revenue to pay the bills and create the profit that pays the owners. This revenue comes from the operating fees charged to shareholders in each of their individual funds. When you own a mutual fund through Fidelity or T. Rowe Price or any investment company other than Vanguard, you are paying for both the operational costs of your fund and for a profit that goes to the owners of your fund company. If I am an owner of Fidelity or T. Rowe Price, I want the fees, and resulting profits, to be as high as possible. If I am a shareholder in one of their funds, I want those fees to be as low as possible. Guess what? The fees are set as high as possible. To be clear, there is nothing inherently wrong with this model. In fact, it is the way most companies operate. When you buy an iPhone, built into the price are all the costs of designing, manufacturing, shipping and retailing that phone to you, along with a profit for the shareholders of Apple. Apple sets the iPhone price as high as possible, consistent with costs, profit expectations, and the goal of selling as many as they can make. It is the same with an investment company. In this example I chose Fidelity and T. Rowe Price not to pick on them. Both are excellent operations with some fine mutual funds on offer. But because they must generate profit for their owners, both are at a distinct cost disadvantage to Vanguard. As are all other investment companies. Bogle's brilliance, for us investors, was to shift the ownership of his new company to the mutual funds it operates. Since we investors own those funds, through our ownership of shares in them, we in effect own Vanguard. With Vanguard, any profits generated by the fees we pay would find their way back into our pockets. Since this would be a somewhat silly and roundabout process and, more importantly, since it would potentially be a taxable event, Vanguard has been structured to operate at cost. That is, with the goal of charging only the minimum fees needed to cover the costs of operating the funds. What does this translate into in the real world? Such fees are reported as expense ratios. The average expense ratio at Vanguard is 0.18%. The industry average is 1.01%. Now this might not sound like much, but over time the difference is immense and it is one of the key reasons Vanguard enjoys a performance as well as a cost advantage. With Vanguard, you own your mutual funds, and through them, Vanguard itself. Your interests and those of Vanguard are precisely the same. This is a rare and beautiful thing, unique in the world of investing. 2. Why are you comfortable holding all your assets with one company? The answer is simple: it is because my assets are not invested in Vanguard. They are invested in the Vanguard mutual funds and, through those, invested in the individual stocks and bonds those funds hold. Even if Vanguard were to implode, a vanishingly small possibility, the underlying investments would remain unaffected. They are separate from Vanguard the company. As with all investments, these carry risk, but none of that risk is directly tied to Vanguard. Now this can start to get very complex, and for the very few of you who care, there's lots of further information you can easily Google. For our purposes here, what's important to know is the following: you are not investing in Vanguard itself, you are investing in one or more of the mutual funds it manages. The Vanguard mutual funds are held as separate entities. Their assets are separate from Vanguard, each carrying their own fraud insurance bonds and their own respective board of directors charged with keeping an eye on things. In a very real sense, each is a separate company operated independently but under the umbrella of Vanguard. No one at Vanguard has access to your money, and therefore no one at Vanguard can make off with it. Vanguard is regulated by the Securities and Exchange Commission, SEC. All of this, by the way, is also true of other mutual fund investment companies, like Fidelity and T. Rowe Price. Those offered in your 401k are, in all likelihood, just fine too. If you have an employer-sponsored retirement plan, like a 401k, that doesn't offer Vanguard funds, by all means invest in it anyway. As we'll discuss in Chapter 19, the tax deferral and any company match contributions make these plans attractive even with subpar fund choices and high fees. 3. What if Vanguard gets nuked? Okay, let's be clear. If the world had ended on December 21, 2012 as the Mayan calendar suggested it might, everything you had invested in Vanguard, or elsewhere, would have gone up in smoke. But, of course, that didn't happen. If a giant meteor slams into Earth setting the world on fire followed by a nuclear winter, your investments are toast. If space aliens arrive and enslave us all, unless you bought human feedlot futures, it's gonna mess up your portfolio. But unlikely and beyond our control, not to mention the scope of this book. That said, lesser disasters can and do happen. Vanguard is based in Malvern, Pennsylvania. What if, God forbid, Malvern is nuked in a terrorist attack? What about a cyber attack? Hurricane? Pandemic? Power outage? Every major company and institution is aware of these dangers, and each has created a disaster recovery plan. Vanguard has one of the most comprehensive going. The company is spread across multiple locations. Its data is held in multiple and redundant systems. If you care to, you can check out their complete plan at www.vanguard.com www.vanguard.com. However, if you are expecting a planet or even just a civilization-ending event, Vanguard's not for you. But then, no investments really are. You're already stocking your underground shelter with canned goods. Short of that, you can sleep just fine with your assets at Vanguard. I do. 4. Am I on the take? This book is such a strong proponent of Vanguard, it is reasonable to ask, am I on the take? Nope. Vanguard doesn't know I'm writing this, and they are not an advertiser on my blog. Nor do they pay me in any fashion whatsoever. Chapter 19. The 401k, 403b, TSP, IRA, and Roth buckets. So far, in Part 2 we've examined the market and looked at some sample portfolios built from the two key index funds I favor and TRFs. Those funds are what we call investments. But in our complex world we must next consider where to hold these investments. That is, which investments go in which buckets. It is important to understand that 401k, IRAs, and the like are not investments themselves. Rather think of them as the buckets that hold the investments we choose. Broadly speaking, there are two types of buckets. Ordinary buckets, tax-advantaged buckets. Now at this point I must apologize to my international readers. These next 3 chapters are about to become very US-centric. I am completely ignorant of the tax situation and/or possible tax-advantaged buckets of other countries. My guess is that, at least for Western-style democracies, there are many similarities. Most modern economies recognize the value of investing and seek to encourage it. Hopefully, it will be possible for you to extrapolate the information here into something relevant to where you live. If not, feel free to skip ahead. Here in the US, the government taxes dividends, interest, and capital gains. But it has also created several tax-advantaged buckets to encourage retirement savings. While well-intentioned, this has created a whole new level of complexity. Volumes have been written about each of these and the strategies now associated with them. Clearly, we haven't the time or space to review them all. But hopefully I can provide a simple explanation of each along with some considerations to ponder. The ordinary bucket is where we hold investments that are not part of any tax-advantaged plan. It is, in a sense, no bucket at all. This is where everything would go where there are no taxes on investment returns and no opportunities to defer them. We would just own what we own. This is where we'll want to put investments that are already tax-efficient. Tax-efficient investments are typically stocks and mutual funds that pay qualified dividends, dividends that receive favorable tax treatment, and avoid paying out taxable capital gains distributions. Such distributions are typical of actively managed funds that engage in frequent trading in their portfolios. Stocks is a classic example of a tax-efficient investment. The dividends it pays are modest and mostly qualified. Because trading, buying and selling, in the fund is rare, so too are taxable gains distributions. Investments that are tax inefficient are those that pay interest, non-qualified dividends, and those that generate taxable capital gains distributions. These are things like some stock funds, bonds, CDs and REITs, real estate investment trusts. These we want to keep ideally in our tax-advantaged buckets as their payouts are then tax-deferred. Let's look at our 3 investments and consider where they might fit. Stocks, VTSAX, Vanguard Total Stock Market Index Fund, currently pays around a 2% dividend and most of the gain we seek is in capital appreciation. It is tax-efficient and we can use our ordinary bucket. However, since this will be a large portion of our total holdings and since any investment can benefit from the tax-advantaged bucket, we will also hold it in our tax-advantaged buckets. Bonds, VBTLX, Vanguard Total Bond Market Index Fund bonds are all about interest payments. Other than tax-exempt municipal bonds, they go into our tax-advantaged bucket. Cash is also all about interest, but, more importantly, it is all about ready access for immediate needs. Ordinary bucket. None of this is carved in stone. There may be exceptions. Proper allocation should trump bucket choice. Your tax bracket, investment horizon, and the like will color your personal decisions. But the above should give you a basic framework for considering the options. Before we look at the specifics of IRAs and 401(k)s, this important note: none of these tax-advantaged buckets eliminates your tax obligation. They only defer it. Fix this in your brain. We are talking about when, not if, the tax due is paid. When the time comes to withdraw this money, taxes will be due. So will penalties if you withdraw before age 59 and a half. And come age 70 and a half, except for Roth IRAs, you will be required to begin withdrawals based on what the actuarial tables say your life expectancy will be. These are called RMDs, or required minimum distributions. We'll discuss this in depth in the next chapter. Don't let this scare you, simply be aware. The benefit of having your investments grow tax-sheltered over the decades is no small thing, and in most cases you should fund these buckets to the maximum the law permits. Withdrawal strategies to minimize taxes. It is worth noting that there are strategies which seek to access this money tax-free, or at least at the lowest possible rate. These involve structuring your earned and investment income so as to fall under the limits the IRS establishes as being tax-free. So while the money you withdraw is legally subject to tax, your tax bracket is such that the actual amount owed is zero. Staying under these limits can also provide the opportunity to shift money tax-free over time from your traditional IRA to a Roth IRA. This is sometimes called a Roth conversion ladder, thus further avoiding taxes when you withdraw and spend it. These are well worth considering if your situation allows for them. You can find details in these posts. From Go Curry Cracker. Never pay taxes again. http://www.geocurrycracker.com/never-pay-taxes-again/GCC versus the RMD. http://www.geocurrycracker.com/never-pay-taxes-again/http://www.gocurrycracker.com/GCC versus RMD/ http://www.geocurrycracker.com/GCC-versus-RMD. From the Mad Fientist. Early Retirement Strategies and Roth Conversion. http://jlcollinsnh.com/2013/12/05/stocks-part-xx- Early Retirement Withdrawal Strategies and Roth Conversion Ladders from a Mad Fientist http://jlcollinson.com/2013/12/05/stocks-part-xx Early Retirement Withdrawal Strategies and Roth Conversion Ladders from a Mad Fientist Traditional IRA versus Roth IRA, The Final Battle. http://www.madfientist.com/traditional-IRA-versus-Roth-IRA Retire even earlier without earning more or spending less. http://www.madfientist.com/retire-even-earlier. http://www.madfientist.com/retire-even-earlier. There are many variations of 401k type and IRA type accounts. We'll look at the basic types here. The rest are branches from these trees. Employer-based tax-advantaged buckets. These are buckets provided by your employer, such as a 401k. They select an investment company that then offers a selection of investments from which to choose. Many employers will match your contribution up to a certain amount. The amount you can contribute is capped. For 2016, the cap is $18,000 per person per year, or $24,000 for those age 50 and older. You can contribute to more than one plan, if you have access to more than one, but the cap is the total for all together, not for each separately. In general, these are very good things, but not as good as they once were. Unfortunately, many of the investment firms operating these programs have seized upon the opportunity to laden them with excessive fees. This is outrageous and offensive, but the advantage of having your investments grow tax-free is not to be missed. Hold your nose and max out your contributions. I always did. Any employer match is an exceptionally good thing. This is free money. Contribute at least enough to capture the full match. Unless Vanguard happens to be the investment company your employer has chosen, you may not have access to Vanguard funds. That's okay. Many 401k plans will have at least one index fund option. Scan the list of funds offered for the ones with the lowest ER, expense ratio. That's where you'll find the index funds, if any. When you leave your employer, you can roll your 401k into an IRA, preserving its tax advantage. Some employers will also let you continue to hold your 401k in their plan. I've always rolled mine over. It gives you more control, greater investment choices, and allows you to escape those ugly fees. You can contribute to both a 401k and a Roth 401k, but the total must fall within the annual contribution caps. 401k and 403b type plans. Contributions you make are deductible from your income for tax purposes. Taxes are due when you withdraw your money. Money withdrawn before age 59 and a half is subject to penalty. After age 70 and a half your money is subject to RMDs. Roth 401k. These are relatively new and not yet widely available. It is worth comparing these bullet points to those of the Roth IRA we'll discuss shortly. Contributions you make are not deductible from your income for tax purposes. All earnings on your investments are tax-free. All withdrawals after age 59 and a half are tax-free. Once you reach age 70 and a half, RMDs take effect. There is no income limit for participating. TSPs, Thrift Savings Plans, these are retirement plans for federal employees, including military personnel. Think of them as a 401k, but better. Unlike the fee-heavy cesspool too many 401k plans have become, a TSP offers a nice, but not overwhelming, selection of very low-cost index funds. Looking at the government's chart of TSP expense ratios going back to 1999, these have ranged from a low of 0.015% in 2007 to a high of 0.102% in 2003. The reason for the variation, to quote the government website, is, the TSP expense ratio represents the amount that participants' investment returns were reduced by TSP administrative expenses, net of forfeitures. Even at their worst, these are very low expense ratios, often lower even than Vanguard index funds, and that's low. Good deal. There are 5 basic TSP funds. The C fund replicates the S&P 500 index. The S fund replicates the small cap index. The F fund is a bond index. The I fund is an international stock index fund. The G fund holds a non-marketable short-term U.S. Treasury security unique to TSPs. Own both the C and the S in about a 75/25 balance and you've basically got VTSAX. But personally I wouldn't bother. I'd just hold the C fund and be done with it. In addition, there are the L funds. These are life cycle funds made up of the other 5 held in various allocations designed for a particular time horizon. L funds are very much like the target retirement funds we discussed in Chapter 16. TSPs are a no-brainer. If you are fortunate enough to have access to them, max them out. And in this one case, because of the ultra-low fees, I wouldn't roll them into an IRA once you leave your job. Individually based tax-advantaged buckets, IRAs. IRAs are buckets you hold on your own in addition to and separate from any employer-sponsored 401k type plans you may have. You have complete control in selecting the investment company and the investments for your IRA. This means you also control costs and can avoid those companies and investments that charge excessive fees. Mine are all with Vanguard. You can only fund these with earned income or money you roll over from an employer-based plan. Typically, earned income is money you are paid for the work you do. There are 3 types of IRAs. For 2016, the total contribution cap is $5,500 per year, or $6,500 for those age 50 and older. Note, this is in addition to the money you can contribute to your employer-based plan. As with the 401k and Roth 401k, you can contribute to both an IRA and a Roth IRA, but again the total must fall within the IRA annual contribution caps. Deductible and Roth IRAs both have income restrictions for participation. Non-deductible IRAs do not. These income limits change year to year and vary according to tax filing status and employer plan coverage. Deductible IRA. Contributions you make are deductible from your income for tax purposes. Deductibility is phased out over certain income levels. All earnings on your investments are tax deferred. Taxes are due when you withdraw your money. Money withdrawn before age 59 and a half is subject to penalty. After age 70 and a half your money is subject to RMDs. Non-deductible IRA. Contributions you make are not deductible from your income for tax purposes. There are no income limits for participating. All earnings on your investments are tax-deferred. Taxes are due on any dividends, interest or capital gains earned when you withdraw your money. Taxes are not due on your original contributions. Since these contributions were made with after-tax money, they have already been taxed. Those last 2 points mean extra record keeping and complexity in figuring your tax due when the time comes. Money withdrawn before age 59 and a half is subject to penalty. After 70 and a half your money is subject to RMDs. Roth IRA. Contributions you make are not deductible from your income for tax purposes. Eligibility to contribute is phased out over certain income levels. All earnings on your investments grow tax-free. All withdrawals after age 59 and a half are tax-free. You can withdraw your original contributions anytime, tax and penalty-free. You can withdraw contributions that are conversions from regular IRAs after 5 years, tax and penalty-free. You can withdraw as much as you like anytime to fund a first-time home purchase or to pay for college-related expenses for yourself and/or your children. There is no RMD. In short, these can be summarized like this. 401k/403b/TSP equals immediate tax benefits and tax-free growth. No income limit means the tax deduction for high-income earners can be especially attractive. But taxes are due when the money is withdrawn. Roth 401k equals no immediate tax benefit, tax-free growth and no taxes due on withdrawal. Deductible IRA equals immediate tax benefits and tax-free growth. But taxes are due when the money is withdrawn. Deductibility is phased out over certain income levels. Non-deductible IRA equals no immediate tax benefit, tax-free growth and added complexity. Taxes are due only on the account's earnings when the money is withdrawn. Contributions can be made regardless of income. Roth IRA equals no immediate tax benefit, tax-free growth and no taxes due on withdrawal. A better non-deductible IRA, if you will. But eligibility phases out over certain income limits. Now, if you've been paying attention, you might be thinking, holy cow. This Roth IRA is looking like one very sweet deal. In fact, it is even looking like it violates what Collins told us to fix in our minds earlier. None of these eliminates your tax obligations. They only defer them. True enough, but as with many things in life there is a catch. While the money you contribute to your Roth does indeed grow tax-free and remains tax-free on withdrawal, you have to contribute after-tax money. That is, money upon which you've already paid tax. This can be easy to overlook, but is a very real consideration. Look at it this way. Suppose you want to fund your IRA this year with $5,000 and you are in the 25% tax bracket. To fully fund your deductible IRA, all you need is $5,000 because, since it is deductible, you don't need any money to pay the taxes due on it. But with a Roth, you'd need $6,250, $1,250 to pay the 25% tax due and still have $5,000 left to fund the Roth IRA. That $1,250 is now gone forever. And so is all the money it could have earned for you compounding over the years. Were you to fund your deductible IRA instead of your Roth, you'd still have this $1,250 which then could be invested in a taxable account. Of course, it is subject to your 25% tax bracket. After paying taxes on it, you'd have $937.50 left to invest. $1,250 x 0.75% equals $937.50. Curious as to what that might look like? Recalling that the average annual return on the S&P 500 for the 40 years from 1975 to 2015 was 11.9%. $937.50 invested each year for 30 years at 11.9% equals $221.9093. Of course, if you fail to invest the tax savings you'll lose this advantage and the Roth would have been the better choice. It can be very emotionally satisfying to fund a Roth, pay the taxes now and be done with them. But it might not be the optimal financial strategy. Because I'm the suspicious type, and the long-term tax advantages of a Roth are so attractive, I start thinking about what might go wrong. Especially since these are such long-term investments and the government can and does change the rules seemingly on a whim. Two potential threats occur to me. The government could simply change the rules and declare money in Roth IRAs taxable. But this is doubtful. Roth IRAs have become so popular and are held by so many people, this seems more and more politically unlikely. Politicians are loath to take anything away from voters. More likely, the government could find an alternative way to tax the money. Increasingly in the US there is talk of establishing a national sales tax or added value tax. While both may have merit, especially as a substitute for the income tax, these would effectively tax any Roth money as it was spent. With all this in mind, here is my basic hierarchy for deploying investment money. Fund 401(k) type plans to the full employer match, if any. Fully fund a Roth if your income is low enough that you are paying little or no income tax. Once your income tax rate rises, fully fund a deductible IRA rather than the Roth. Keep the Roth you started and just let it grow. Finish funding the 401(k) type plan to the max. Consider funding a non-deductible IRA if your income is such that you cannot contribute to a deductible IRA or Roth IRA. Fund your taxable account with any money left. Let's finish this chapter with the recommendation that, whenever possible, you roll your 401(k/403(b), but not your TSP, accounts into your personal IRA. Usually this will be when you leave your employer. As we've already seen, employer plans are all too frequently laden with excessive fees and your investment choices are limited. In your IRA you have far more control. Personally, I've always been slightly paranoid about having my employers involved in my investments any longer than I had to. The moment I could roll my 401(k) into my own IRA, I did. One final note. We've touched a bit on tax laws in this chapter. While the numbers and information are current as of this writing, should you be reading this book a few years after publication, they are sure to have changed. The basic principles should hold up for some time, but look up the specific numbers that are applicable for the year in which you are reading. Chapter 20. RMDs, the ugly surprise at the end of the tax-deferred rainbow. Someday, if all goes well, you'll wake up to find you've reached the ripe old age of 70 and a half. Hopefully in good health, you'll rise from bed, stretch and greet the new day happy to be alive. You've worked hard, saved and invested, and now are contentedly wealthy and secure. Since you've diligently maxed out your tax-advantaged accounts, much of that wealth might well be in those, tax-deferred for all these years. On this day, if you haven't already, you'll begin to fully appreciate the deferred part of that phrase. Because your Uncle Sam is waiting for his cut and he figures he's waited long enough. Except for the Roth IRA, all of the tax-advantaged buckets discussed in Chapter 19 have RMDs, required minimum distributions, as part of the deal, and these begin at age 70 and a half. Basically this is the Fed saying, okay. We've been patient but now, pay us our money. Fair enough. But for the readers of this book who are building wealth over the decades, there may well be a very large amount of money in these accounts when the time comes. Pulling it out in the required amounts on the government time schedule could easily push us into the very highest tax brackets. Make no mistake, once you reach 70 and a half, these withdrawals from your IRAs, 401(k), S, 403(b), S and the like are no longer optional. Fail to take your full distribution and you'll be hit with a 50% penalty. Fail to withdraw enough and the government will take 50% of however much your shortfall is. That's right, they will take half of your money. This is not something you want to overlook. The good news is that if you hold your accounts with a company like Vanguard, they will make setting up and taking these distributions easy and automatic, if not painless. They will calculate the correct amount and transfer it to your bank, money market, taxable fund, or just about any place else you choose and on the schedule you choose. Just be sure to get the full RMD required each year out of the tax-advantaged account on time. Just how bad a hit will this be? Well, there are any number of calculators online that allow you to plug in your exact numbers for an accurate read of your situation. Vanguard has their own, but so do companies like Fidelity and T. Rowe Price. To give you an idea of what the damage might look like, I plugged into Fidelity's to provide the following example. You'll be asked your birth date, the amount of money in your account as of a certain date, December 31st 13 when I did it, and to select an estimated rate of return. I chose January 1st 1945, $1 million and 8%. No, those are not my real numbers. In a flash the calculator gave me the results year by year. Here's a sample. Year RMD age balance 2015 $39,416 $71,127,000 2020 $57,611 75 $1,367,000 2025 $82,836 $81,590,000 2030 $116,271 85 $1,742,000 2035 $154,719 $91,750,000 The good news is that even with these substantial withdrawals, the total value of our account will continue to grow. But, as we've discussed before, these are estimated projections. The market might do better or worse than 8% and it most certainly won't deliver 8% reliably each year on schedule. The bad news is, not only do we have to pay tax on these withdrawals, the amounts could push us into a higher tax bracket. Or two. This, of course, will depend on how much income you have rolling in from your other investments, Social Security, pensions and the like. To give you a frame of reference, here are the tax brackets for those married and filing jointly in 2016. 0 to $18,550, 10% $18,551 to $75,300, 15% $75,301 to $151,900, 25% $151,901 to $231,450, 28% $231,451 to $413,350, 33% $413,351 to $466,950, 35% $466,951 or more, 39.6%. Based on this, we can see that even with no other income, by age 90 our taxpayers' RMD of $154,719 will put them in the 28% tax bracket even without considering any other income. And that's based on starting with only $1 million. Many readers applying the principles in this book starting in their 20s, 30s and 40s can easily expect to have several multiples of that by the time they reach 70 and a half. Something that is important to note here, which confuses many people, is that this doesn't mean they pay 28% of the full $154,719 in taxes. Rather they pay 28% only on the amount over the $151,900 threshold of the bracket. The rest is taxed at the lower brackets on down. Should their other income bump them over the $231,450 threshold for the 33% bracket by, say, $1, they will only pay 33% in tax on that $1. If you think of the RMD as the last money added, it is the money taxed at the highest rates. For instance, if they have $75,300 in other income, Taking them right up to the 25% bracket line, any amount of RMD will be taxed at 25% or more. All of this is before any other deductions and exemptions. Those serve to reduce your taxable income. While looking at all the possible variations is a discussion beyond the scope of this book, we can consider an example. For 2016, a married couple gets a standard deduction of $12,600 and personal exemptions of $8,100, $4,050 each. In effect, this means they don't reach the 25% bracket until their AGI, adjusted gross income, reaches $96,000. $96,000 to $8,100, $12,600 equals $75,300, so is there anything to be done? Possibly. Assuming when you retire your tax bracket drops, you have a window of opportunity between that moment and age 70 and a half. Let's consider the example of a couple who retires at 60 years old, using the numbers above. They have a 10-year window until 70 and a half to reduce their 401(k)/IRA holdings. They are married and filing jointly. For 2016, the 15% tax bracket is good up to $75,300. The personal exemption is $4,050 per person or $8,100 for our couple. The standard deduction is good for another $12,600. Add all this together and they can have up to $96,000 in income before they get pushed into the 25% bracket. If their income is below $96,000, they might seriously consider moving the difference out of their IRA and/or 401(k) and taking the 15% tax hit. 15% is a low rate and worth locking in, especially given that 10 years from now their tax bracket could be twice that or more. It's true they lose the money they pay in taxes and what it could have earned, as we saw with the Roth versus deductible IRA discussion in the last chapter, but we are now only talking about 10 years instead of decades of lost growth. So, if they have $50,000 in taxable income, they could withdraw $46,000 for a total of $96,000. They could put the $46,000 in their Roth, their ordinary bucket investments, or just spend it. Rolling it into a Roth would be my suggestion and is in fact what I am personally doing. You don't have to wait until you are 60 or even until you are fully retired to do this. Anytime you step away from paid work and your income drops. This is a strategy to consider. However, remember, the further away from age 70 and a half you are, the more time you give up during which the money you pay in tax today could have been earning for you over the years. There is no one solution. If as you approach age 70 and a half your 401(k)/IRA amounts are low, you can just leave them alone. If they are very high, however, starting to pull them out even at a 25% tax rate might make sense. The key is to be aware of this looming required minimum distribution hit so that, as much as possible, you can take it on your own terms. Once again, in this chapter we've touched a bit on tax laws and the information is current as of 2016. By the time you are reading this book, the laws may well have changed. Be sure to look up the specific numbers that are applicable for the year in which you are reading. Chapter 21. HSAs, more than just a way to pay your medical bills. Much has been changing in the world of healthcare here in the U.S. While the opinions on these changes vary widely, one thing I can say with some certainty is that the number of people having access to and choosing high-deductible health insurance plans is likely to increase. These plans basically allow you to self-insure for part of your healthcare costs in exchange for lower premiums. In the past, most health insurance plans came with very low deductibles and paid for most every medical cost beyond them. Those were the good old days. As medical costs have skyrocketed, so have the insurance premiums required to provide such comprehensive coverage. Now, by having the insured shoulder some of the risk, the high-deductible plans are able to offer insurance against catastrophic illness and injury at more affordable rates. In exchange, the insured is responsible for paying the first medical bills out of pocket each year, typically $5,000 to $10,000. To make this a bit more affordable and attractive, HSAs, health savings accounts, were created to help handle these out-of-pocket expenses. Basically, these are like an IRA for your medical bills and, as we'll see, the way they've been constructed creates some very interesting opportunities. With an HSA, as of 2016, you can set aside up to $3,350 for an individual and $6,750 for a family each year. If you are 55 or older, you can add another $1,000 to each of those. Like an IRA, you can fund this account with pre-tax money. Or, put another way, your contribution is tax-deductible. You can open an HSA regardless of your income or other tax-advantaged accounts to which you might also be contributing. Here are some key points. You must be covered with a high-deductible health insurance plan to have an HSA. Your contributions are tax-deductible. If you use a payroll deduction plan through your employer, your contribution is also free of Social Security and Medicare taxes. You can withdraw the money to pay qualified medical expenses anytime, tax and penalty-free. Any money you don't spend is carried forward to be used whenever you need it. Qualified medical expenses include dental and vision, things often not part of healthcare insurance plans these days. You can use your HSA to pay the healthcare costs of your spouse and dependents, even if they are not covered by your insurance plan. If you withdraw the money for reasons other than to pay for medical expenses, it is subject to tax and a 20% penalty. Unless you are age 65 or over, or if you become permanently disabled, in which case you'll owe only the tax due. When you die, your spouse will inherit your HSA and it will become his or hers with all the same benefits. For heirs other than spouses, it reverts to ordinary income and is taxed accordingly. This is also a good moment to point out that, while HSAs are often confused with FSAs, flexible spending accounts, they are not at all the same. The key difference is that with a FSA, any money you don't spend in the year you fund the account is forfeited. The money in your HSA, and anything it earns, remains yours until you use it. What we have here is a very useful tool, and one well worth funding for those who have access to it. But as promised above and as might be said on a late-night TV infomercial. Wait, there's more. Some additional key points. You are not required to pay your medical bills with your HSA. If you choose, you can pay your medical bills out of pocket and just let your HSA grow. As long as you save your medical receipts, you can withdraw money from your HSA tax and penalty-free anytime to cover them. Even years later. Those who plan to use this money to pay current medical bills are best served, as with all money you plan to spend in the short term, keeping it in a FDIC-insured savings account. But, you can choose to invest your HSA anywhere, such as in index funds like VTSAX. Once you reach the age of 65, you can withdraw your HSA for any purpose penalty-free, although you will owe taxes on the withdrawal unless you use it for medical expenses. As we sit back and ponder all this, an interesting option occurs. Suppose we fully funded our HSA and invested the money in low-cost index funds. Then we'd pay our actual medical expenses out of pocket, carefully saving our receipts, while letting the HSA grow and compound tax-free over the decades. In effect, we'd have a Roth IRA in the sense that withdrawals are tax-free and a regular IRA in the sense that we get to deduct our contributions to it. The best of both worlds. If we ever needed the money for medical expenses, it would still be there. But if not, it would grow tax-free to a potentially much larger amount. When we were ready, we would pull out our receipts and reimburse ourselves tax-free from our HSA, leaving any balance for future use. Should we be fortunate enough to remain healthy, after age 65 we would be able to take it out to spend as we please, just as with our IRA and 401k accounts, paying only the taxes then due. And how about those nasty RMDs discussed in the last chapter? Well, so far the law has been silent on this point. It could go either way. Keep your fingers crossed. The bottom line is that anyone using a high-deductible insurance plan should fund an HSA. The benefits are simply too good to ignore. Once you do, if you choose you can turn it into an exceptionally powerful investment tool. I suggest you do. Chapter 22. Case Study, Putting the Simple Path to Wealth into Action. So far we've discussed concepts and strategies to create your own simple path to wealth. For those few of you reading who are just starting out, this should be perfectly easy to implement. But most of you are already somewhere along your path. Perhaps you've made some mistakes and hold some investments you wish you had never made. Perhaps you hold too many different assets and realize now it doesn't have to be that complex. Regardless, you already have things in place that need to be considered. How, you might be asking, can I implement these ideas in the real world? Clearly, I have no way of answering that for each reader who picks up this book. But in this chapter, I'll share with you a real-life reader case study drawn from www.jlcollinsnh.com www.j. If we ever needed the money for medical expenses, it would still be there. But if not, it would grow tax-free to a potentially much larger amount. When we were ready, we would pull out our receipts and reimburse ourselves tax-free from our HSA, leaving any balance for future use. Should we be fortunate enough to remain healthy, after age 65 we would be able to take it out to spend as we please, just as with our IRA and 401k accounts, paying only the taxes then due. And how about those nasty RMDs discussed in the last chapter? Well, so far the law has been silent on this point. It could go either way. Keep your fingers crossed. The bottom line is that anyone using a high-deductible insurance plan should fund an HSA. The benefits are simply too good to ignore. Once you do, if you choose you can turn it into an exceptionally powerful investment tool. I suggest you do. Chapter 22. Case Study, Putting the Simple Path to Wealth into Action. So far we've discussed concepts and strategies to create your own simple path to wealth. For those few of you reading who are just starting out, this should be perfectly easy to implement. But most of you are already somewhere along your path. Perhaps you've made some mistakes and hold some investments you wish you had never made. Perhaps you hold too many different assets and realize now it doesn't have to be that complex. Regardless, you already have things in place that need to be considered. How, you might be asking, can I implement these ideas in the real world? Clearly, I have no way of answering that for each reader who picks up this book. But in this chapter, I'll share with you a real-life reader case study drawn from www.jlcollinsnh.com www.jlcollinsnh.com. For the purposes of this chapter, I've taken the liberty of consolidating this reader's questions and situation, and have done some editing for clarity. Other than that, where he is quoted all the words are his. His note. I'm 26 and have recently graduated from college, and decided to get my financial life in order. Luckily, I was able to find a great job and have no debt. I am working on saving up my emergency fund, roughly 24% of my income is going into it, and now I'm focusing my efforts on investments. My grandparents seeded an investment fund for all of their grandchildren when each was born. It has been managed by a financial advisor for years, and your posts have confirmed my thoughts that I can do better. It currently has around $35,000 in it in 12 different mutual funds. My grandmother doesn't remember the exact amount that started my account. Whenever a new grandchild was born, she would put in a starting amount equal to what was in the older children's accounts. The earliest record is from 1994. At the start of that year, there was approximately $6,700 in the account and $1,000 was added by my grandparents each year until it hit around $25,000. In 1994, the funds were half stocks and half bonds. My grandfather grew up during the Great Depression and didn't fully trust stocks. My employer offers a 403(b) plan and they match contributions up to 2.5%. Currently, I put 3% of my income into this. Vanguard's Total Stock Market Index Fund is one of the available options. I make $70,000 per year before taxes. Right now I'm saving 24% of my pay. My goal is to keep it at 20% or more, but realize I might have to drop to 15% if other commitments arise. I haven't really thought about when I want to retire. It would be great to retire early, but I have not officially set that goal. I think I'm also going to do a Roth IRA on my own. What is your suggestion on getting rid of my financial manager and all the mutual funds and buying into VTSAX? I don't fully understand the tax implications that are involved in that. Correct me if I'm wrong, but $5,500 would go into the Roth and the rest into a traditional account. Is it okay to have the investments in my 403(b) Roth IRA and my regular account in VTSAX? What is the best way to contribute to my funds? After I get my emergency fund built up and my money transferred to Vanguard, I will have around $1,000 per month. Do I put that in each month or wait to put in larger amounts? I have heard of dollar cost averaging, but haven't looked into it. Thanks for your advice and time. The beginning of my response was this. Before we get started, some congratulations are in order. No, not for you. For your grandparents. They deserve big-time major league kudos. Please tell them I said so. The fact that they have provided this seed capital for you and their other grandchildren tells me several things. They have resources, and that means they are fiscally responsible and effective in their own lives. They are generous. And, considering your questions and plans, clearly they have passed this on to their descendants. If you haven't already, take them out to dinner and raise a toast in their honor. If you already have, do it again. Looking at his situation, we have a great base upon which to build. $35,000 in capital to start. $70,000 salary and he is saving 24%, or $16,800 annually. He wants to target saving about 20% going forward, or $14,000. As you'll see, I'll try to persuade him to increase that. He's landed a good job with an employer that provides a 403(b) retirement plan. Zero debt. He's not sure about retirement yet, no surprise at age 26, but he recognizes the importance of FU money. He wants to know how to contribute to his investments going forward and about dollar cost averaging. Let's talk first about what investment to choose. Fortunately, his employer's benefits plan offers Vanguard as an option. He is leaning toward Vanguard's Total Stock Market Index Fund and that idea is spot on. In fact, this is where we'll put all of his investments. He is in the wealth accumulation phase of his life and it's the right tool for the job. In Chapter 17 we learned there are 3 options to owning this fund portfolio: Admiral shares, investor shares, and VTI, an ETF, exchange-traded fund. VTSAX is the Admiral version and provides the lowest cost, but has a $10,000 minimum buy-in. The investor shares option, VTSMX, holds the same portfolio, but with slightly higher costs and a $3,000 minimum. He should use Admiral shares whenever he can and investor shares if needed as a start. Once the account reaches $10,000, Vanguard will automatically switch it to the lower-cost Admiral shares. As we've seen, this one fund gives him a portfolio that owns virtually every publicly traded company in the U.S. Since many of these have extensive international operations, he'll also have international market exposure. With this one investment he'll have broad diversification in the most powerful wealth-building asset of all, stocks. This allocation of 100% Stocks is considered very aggressive, and that's what we want for this phase. But be warned, as you know from reading the previous chapters, he can expect a wild and gut-wrenching ride. With that said, he's going to stick to the plan, keep investing and tough it out. At 26, he has decades ahead. At some point he'll start thinking about retirement. That retirement might not come until he's 65, or maybe he'll choose to implement it when he has FU money around age 35 or so. Whenever the time comes, as he approaches that phase, he'll want to consider diversifying into bonds. But right now, in the wealth accumulation phase, stocks are where his money belongs, and VTSAX is how best to own them. Next, let's look at the various investment buckets he has available and discuss how to allocate his VTSAX investment among them. You'll recall that these buckets are where we hold the investments we choose. In order of desirability, the buckets are: 1. His 403b employer plan. Since he works for a university, he has a 403b plan, rather than the 401k plans common in private industry. He plans to contribute 3% of his salary, which will be tax deferred, and his employer matches 2.5%. That's free money. That makes this option number 1. 2. Deductible IRA. This is very much like his employer plan in that his contributions to it are deductible and its earnings are tax deferred. The important advantage, however, is that he has full control over his investment choice and is not limited to those in his plan. He will open his IRA with Vanguard and will choose VTSMX/VTSAX. Since his 403b options are excellent, this matters less in his case. But in many employer-based plans, the choices available are not optimal. If you have such a plan, use the guidelines provided in Chapter 19 to find the option that most closely matches a total stock market index fund or an S&P 500 index fund. Most plans have versions of these. Fund it up to the maximum of any company match. Then turn to your personal IRA. Once that's fully funded, turn again to your employer plan up to the maximum. Currently, the maximum annual IRA contribution limit is $5,500, and he should try to fund it as close to the limit as possible. The tax advantages are too sweet to leave behind. 3. Back to his 403b. Current law allows him to contribute up to $18,000 each year to his 403b, and at 3% he has only put in $2,100 so far. That leaves $15,900 in potential contributions. Since he is only planning to save 20% $14,000 of his income, he should contribute another $6,400 to his 403b, $2,100 plus $5,500 plus $6,400 equals $14,000. But as I said, we are going to try to persuade him to save more. Instead, he could max out his 403b plan by adding $15,900 to the $2,100 he is already contributing for the employer match, for a total of $18,000. Add to this the $5,500 going into his IRA, and the total is $23,500. That's a saving rate of 33.57%. At this point, it is worth noting that I am calculating these savings rates based on his pre-tax income. Some would argue that using post-tax income is better, as that is what he actually has available to spend. But taxes are very complex, and the post-tax income generated from any specific pre-tax income is likely to vary widely. Using pre-tax is just simpler, and, because it tends to encourage saving greater dollar amounts, it is more in keeping with the ethic of this book. For anyone serious about achieving financial independence, taking full advantage of all your tax-deferred opportunities is a must. And doing so starts to get you into a respectable saving rate. But there is no reason to stop here. 4. Ordinary bucket. This is where we put regular investments made outside any tax-advantaged buckets. He'll pay taxes on the dividends and capital gains distributions each year, but, unlike tax-advantaged accounts, the money is available anytime with no penalty. This is where his $35,000 spread across multiple mutual funds is now. When he moves it to VTSAX, that will still be the case. Once he sells the 12 funds he currently owns, assuming they have appreciated in value, he'll owe a capital gains tax. Given this relatively small amount of money and the fact that capital gains taxes are low at the moment, this is nothing to lose sleep over. However, were the amount significantly higher, this decision would become more complex. In such a case, it would require a thoughtful analysis of the investments currently held and their costs balanced against the tax liability. So here is where we are. His savings rate is currently 24% as he builds an emergency fund, and he plans to reduce this to 20%. Compared to the average American, these numbers are excellent. Compared to where he wants to be, he should consider doing more. A 50% savings rate is my suggestion, but others more committed to having FU money commonly reach for 70 to 80%. He is already stepping out of the norm by being debt-free, saving and investing. He is employed, young and childless. Never will he be in a stronger position to take it to the next level. At the very least, he should avoid lifestyle inflation by pledging that any salary increases will go towards his investments. If he does this now, in the future his problem will be how to spend all the money his money earns for him. Okay, with all that under our belt, let's run some numbers and look at a couple of options, with their specifics. Option number 1, 24% savings rate. We'll forget about reducing this to 20% as doing so doesn't get him where he wants to be. He starts with the $35,000 from his grandparents and moves it immediately into VTSAX, paying the capital gains tax, if any. As we've seen, the average market return of the past 40 years, January 1975, January 2015, has been 11.9% annually. At that rate his money doubles about every 6 years. By the time he is 62, in 36 years, it will have doubled nearly 6 times over. A quick calculation shows he'll have over $2 million, without adding a single penny. By the time he is 68 it will double again to $3,900,000. That's the power of compounding. Did I mention he should take his grandparents to dinner? If you add to it as you go along, as he's going to, the results become even more dramatic. Using his current savings rate of 24%, he'll have $16,800 of his $70,000 salary to invest each year. His 403b gets 2.5% of his salary to capture the match, but he's contributing 3%. That's $2,100 per year. His employer will add 2.5%. Another $1,750, but that's in addition to his 24% $16,800 investment money. This will go into VTSAX as his plan offers it. If it did not, the money would go into the choice his plan offered that most closely resembles VTSAX. His deductible IRA gets $5,500. That goes into VTSMX, and this will move to VTSAX once over $10,000. Between the 403b and the IRA we've accounted for $7,600 of his $16,800. For the remaining $9,200, we'll return to the 403b and put it there. Don't let this 3-step process confuse you. It is only to walk through the selections in order of attractiveness. Once he's done that, the actual implementation would be simply fund the 403b with $11,300, $2,100 plus $9,200, fund the IRA to the maximum of $5,500. Option number 2, 50% savings rate. Now let's see what happens if we can persuade him to get a little more serious about saving and investing. Again, he starts with the $35,000 from his grandparents, but now we have another $35,000, 50% of $70,000, each year to invest from his salary. As before, his 403b plan gets 3% of his $70,000 salary, $2,100, and his employer matches 2.5%. His deductible IRA investing in VTSMX also still gets the maximum contribution allowed, $5,500. So between the 403b and the IRA we've again accounted for $7,600, but now leaving $27,400 to invest. With this we can take full advantage of the 403b by contributing $15,900 more. Add this to the $2,100 he contributed to get the match and he's reached the maximum annual limit of $18,000. And he still has $11,500 left over. $35,000 to $2,100, $5,500 to $15,900 equals $11,500. We'll add this $11,500 to VTSAX in the ordinary bucket and build on the $35,000 seed capital his grandparents so generously provided. With option number 2, it is not hard to see how much more powerfully his wealth will grow. He is taking full advantage of all the tax-advantaged plans available and is building wealth outside them that he can access anytime without penalty. Of course, this requires that he organize his life in such a fashion as to live on the remaining $35,000. For some readers this might appear appallingly low, for others, extravagantly high. Either way it is certainly doable. It is simply a matter of choice and priorities and how much he values financial freedom. Here's a fun fact: an income of $35,000 puts you in the top 0.81% of world incomes. Congratulations 1%, Want to know where your income puts you? Check it out here, www.globalrichlist.com www.globalrichlist.com. Finally, let's talk briefly about how these contributions will happen. Like most people, he'll be investing as his money is earned. He'll be doing this with his 403b, IRA, and any additional money he adds to his ordinary bucket VTSAX account initially funded with the $35,000. This is in effect a form of dollar cost averaging, DCA, that is investing chunks of money evenly over time. DCA is something we'll discuss in depth in Chapter 26. The beauty of his 403b account is that once he sets it up, the contributions will happen automatically. The IRA and ordinary bucket VTSAX accounts will require him to expend a bit more effort. He'll either have to remember to add to them regularly, just like paying one's bills, or he can set them up with Vanguard to have the money automatically transfer. Automatic's what I'd do. It is easier and makes it more likely he'll stay the course. There you have it. If he follows this simple path, he'll have FU money before he knows it and working will become optional. By the time he reaches his grandparents' age he will be well able to provide seed money accounts for his own grandkids, continuing the cycle. Around then he might also consider learning how to give like a billionaire, which we'll discuss in Chapter 32. Note: if you are interested in the original version of this case study, you'll find it as a post titled The Smoother Path to Wealth on www.jlcollinsnh.com www.jlcollinsnh.com. You can find several more case studies there, each covering a different and unique situation. Just look under Categories, Case Studies in the right-hand column. For answers to a variety of simpler questions, click the button at the top labeled Ask Jill Collinson. Chapter 23. Why I don't like investment. Advisors. Managing other people's money is a very big business, and for those who engage in it, a very lucrative one. Since investing and managing money is highly intimidating for many folks, there is also an apparent need. This financial stuff just all seems so complex, it is not surprising that many people welcome the idea of turning it over to a professional who will, hopefully, get better results. Unfortunately, most advisors don't get better results. Investing only seems complex because the financial industry goes to great lengths to make it seem complex. Indeed, many investments are complex. But as you now already understand, not only are simple index investments easier, they are more effective. Advisors are expensive at best and will rob you at worst. Google Bernie Madoff. If you choose to seek advice, seek it cautiously and never give up control. It's your money and no one will care for it better than you. But many will try hard to make it theirs. Don't let it happen. When I say investment advisors, I am also referring to money managers. Investment managers, brokers, insurance salespeople, who often masquerade as financial planners, and the like. Any and all who make their money managing yours. Now, I'm sure there are many honest, diligent, hardworking advisors who selflessly put their clients' needs ahead of their own. Actually, I am not at all sure about that. But just in case, I put it out there in fairness to the few. Here's the problem. By design, structurally an advisor's interests and that of their clients are in opposition. There is far more money to be made selling complex fee-laden investments than there is in simple low-cost efficient ones. To do what's best for the client requires the advisor to do what is not best for himself. It takes a rare and saintly person to behave this way. Money management seems not the calling of the rare and saintly. Well-intentioned but bad advice is endemic in this field. Advisors who put their clients' interests ahead of their own are, to steal a phrase from Joe Lansdale in his novel Edge of Dark Water, rarer than baptized rattlesnakes. And then you've got to find one who is actually any good. Advisors are drawn not to the best investments, but to those that pay the highest commissions and management fees. Indeed, often they are compelled by their firms to sell these types of investments. Such investments are, by definition, expensive to buy and own. And investments that are expensive to buy and own are, by definition, poor investments. Not surprisingly, a field that provides access to people's life savings is a magnet for con men, thieves, and grifters. Let's take a look at how investment advisors earn their money, and how each method works against you. Remember now, here we are talking about those who are legitimate, rather than the outright crooks. Generally there are three ways. 1. Commissions. The advisor is paid each time you buy or sell an investment. These commissions in the investment world are called loads. It's not hard to see the potential for abuse here, and the conflict of interest is stark. There is no load commission charged to buy a Vanguard fund. But American funds, among others, charge a princely load. Typically it is around 5.75% and it goes directly into the pocket of the advisor. This means that if you have $10,000 to invest, only $9,425 actually goes to work for you. The other $575 is his. Wonder which he'll recommend. Some funds offer a 1% recurring management fee to the advisors who sell them. That means you get to pay a commission not only once, but every year for as long as you hold the fund. No surprise advisors favor these two. Often this fee and a load are found in the same investment. Further, since these funds are most often actively managed, they carry a high expense ratio and are mostly doomed to underperform the simple low-cost index funds we can so easily buy on our own. Consider how all this can add up. Take a 5.75% load, combined with a 1% management fee, along with an expense ratio of, say, 1.5% and you've given up 8.25% of your capital right from the start. That's money you not only lose forever, you also lose all the money it could have earned for you over the decades. Compare that with the 0.05% expense ratio of VTSAX. Holy crap! Insurance investments are some of the highest commission payers. This makes them perhaps the most aggressively recommended products advisors offer and certainly among the most costly to you. Annuities and whole/universal life insurance carry commissions as high as 10%. Worse, these commissions are buried in the investment so you never see them. How such fraud is legal I can't say. But it is. Hedge funds and private investments all make their salespeople wealthy, along with the operators. Investors? Maybe. Sometimes. Nah, not so much. Remember Bernie Madoff? People literally begged him to take their money. His credentials were impeccable. His track record too. Only the best investment advisors could get you in. Mr. Madoff paid them handsomely to do so. As did their clients. Oops. If all this weren't enough, if you're not paying attention, there is more money to be mined at your expense by churning your account. Churning refers to the frequent buying and selling of investments to generate commissions. It is illegal. But it is also easily disguised, principally as adjusting your asset allocation. 2. The AUM, Assets Under Management, model. With the rampant abuse of the commission model, in recent years charging flat management fees has grown in popularity. These fees are typically 1–2% of the client's total assets, and this approach is presented as being more objective and professional. But there are snakes in this grass as well. First, 1–2% annually is a huge drag on the growth of your wealth and on your income once you are living off it. Investment returns are precious, and under this model your advisor is skimming the absolute cream. Suppose you have a nest egg of $100,000. That's about the minimum needed to interest an advisor. Let's further suppose you invest it for 20 years and earn 11.9% per year, which as we've seen is the average annual return of the past 40 years, January 1975 to January 2015, 1. You end up with $947,549.30. Not bad. Now suppose you give up 2% of these annual gains to a management fee. Your net return is now 9.9%, and after 20 years that yields $660,623.30. That's a whopping $286,926 less. Yikes. You not only give up the 2% each year, you give up all the money that money would have earned compounding for you over the 20-year period. Let me hammer this point home, it's a very big deal. Second, we still have the problem of a conflict of interest. With the AUM model it is not as pervasive as with the commission model, but it's still there. Maybe you are considering paying off your $100,000 mortgage. Or perhaps you're thinking about whether to contribute $100,000 to your kids' college education so they can avoid going into debt. Often advisors will advise against either of these courses. For you, depending on your situation, that may be good or bad advice. For your advisor, it is the only advice that preserves the $1,000 to $2,000 in annual fees that $100,000 puts in their pocket. Third, the vast majority of advisors are destined to cost you still more money as they underperform the market. The actively managed funds they tend to choose woefully underperform the index. You won't know for 20 years or so if you got lucky enough to pick one of the exceedingly rare ones that don't. 3. Hourly fees. Many advisors tend to dislike this model, pointing out that it often limits the time a client is willing to spend with them. That's true as far as it goes, but it is also true that it takes a lot of hours to equal the money that can be made in commissions and annual fees. They also point out that clients are less likely to object to commissions and fees because they tend not to notice these being skimmed off the top. Paying an hourly rate, even when it is more cost-effective, requires writing out the check and actually seeing the money leave your hands. That's uncomfortable for the clients, and that means less money for the advisor. Not such a bad thing for the clients, seems to me. That said, if you really need advice, this is the most straightforward way to pay for it. But pay for it you will. Rates of $200 to $300 plus per hour are not uncommon. You are less likely to be cheated, but you still have the challenge of knowing if the advice itself is going to be good or bad for your financial health. 4. Some combination of 1, 2 and 3 from above. This is our last option. If your advisor is using it, likely the reason is not for your benefit. So what's my advice on picking a good advisor? Beats me. Doing so is probably even more difficult than picking winning stocks or actively managed mutual funds. Advisors are only as good as the investments they recommend. Since those are mostly actively managed funds, as opposed to the index funds this book suggests, how often do those outperform? As we saw in Chapter 8, very rarely. You'll recall the research shows 20% outperform in any given year, and looking at a 30-year period that drops to less than 1%. Statistically speaking, that's a rounding error, just so much noise. This is what your highly paid advisor is selling you. If you are a novice investor, you have two choices. You can learn to pick an advisor. You can learn to pick your investments. Both require effort and time. But the second not only provides better results, it is the easier and less expensive path. Hopefully this book is showing where it lies. The great irony of successful investing is that simple is cheaper and more profitable. Complicated investments only benefit the people and companies that sell them. Remember that nobody will care for your money better than you. With less effort than choosing an advisor, you can learn to manage your money yourself, with far less cost and better results. Part 3. Magic Beans. Wisdom comes from experience. Experience is often a result of lack of wisdom. Terry Pratchett. Chapter 24. Jack Bogle and the Bashing of Index Funds. While no one ever has, if someone were to ask me what single thing has most impeded the growth of my personal wealth, the answer would be my stubborn rejection of the concept of indexing for an embarrassingly long number of years. Indeed, when I hear the arguments against it, it is my own voice in my head I hear. I made them all too often and far too long. So, why is it that the concept of indexing meets with such resistance in some quarters? First, a little background. Jack Bogle founded the Vanguard Group in 1974. He is the creator of the modern low-cost index fund and my personal hero. If you aspire to be wealthy and financially independent, he should be yours as well. Before Mr. Bogle, the financial industry was set up almost exclusively to enrich those selling financial products at the expense of their customers. It mostly still is. Then Mr. Bogle came along and exposed industry stock-picking and advice as worthless at best, harmful at worst, and always an expensive drag on the growth of your wealth. Not surprisingly, Wall Street howled in protest and vilified him incessantly. Mr. Bogle responded by creating the first S&P 500 index fund. The wails and gnashing of teeth continued even as Bogle's new fund went on to prove his theories in the real world. As the years rolled on and the evidence piled ever higher, Mr. Bogle's critics began to soften their voices, mostly I'd guess because they had begun to sound pretty silly. Other fund companies, realizing that people were becoming ever less willing to accept high fees for questionable performance, even began to offer their own low-cost index funds in an effort to keep their customers from walking out the door. Personally, I've never believed their hearts were in it, and for that reason my money stays at Vanguard. The basic concept behind Vanguard is that an investment firm's interests should be aligned with those of its shareholders. This was a stunning idea at the time, and to this day it is the only firm that is, and as such is the only firm I recommend. The basic concept behind indexing is that, since the odds of selecting stocks that outperform is so very small, better results will be achieved by buying every stock in a given index. This was soundly ridiculed at the time. And in some quarters it still is. But increasingly over the past 4 decades the truth of Bogle's idea has been repeatedly confirmed. With that confirmation, the amount of money invested in index funds has continued to gain share. Even Warren Buffett, perhaps history's most successful stock picker, has gone on record as recommending indexing, specifically for his wife's trust once he has passed. In the Berkshire Hathaway 2013 annual shareholder letter, Buffett writes, "My advice could not be more simple: put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I suggest Vanguard's I believe the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals, who employ high-fee managers. So with all this evidence piling up, why then do some still bash the concept? As we saw in Chapter 11, basically it boils down to human greed, psychology and money. In short, there is too much money to be made and too much weakness in human psychology for actively managed funds and managers to ever go away. In fact, even with the growing acceptance of indexing, there are still about 4,600 equity, stock, mutual funds being offered as of this writing. To put this in perspective, there are only about 3,700 publicly traded U.S. companies for them to invest in. Yes, you read that correctly. As we saw in Part 2, there are more stock mutual funds out there than there are stocks for them to buy. Wall Street is endlessly creating new products and schemes to sell you, even as they systematically and quietly close those that have failed, which serves to make their track record seem better. But make no mistake, the objective is always to line their pockets, not yours. My advice, use the index funds and the company Mr. Bogle created and keep what is yours. Chapter 25. Why I can't pick winning stocks and you can't either. Don't feel bad. As we've seen, most professionals can't either. Indexing versus active management is always a fascinating debate, at least for us stock geeks with nothing better to do. Over the decades I've been on both sides of it. For a very long time I laughed at the indexers. I made all of the arguments, and then some. After all, if you just avoided the obvious dogs you'd do better than average, right? As we saw in the last chapter, it's not that easy. But in the summer of 1989, I was still convinced I could win this game. On a flight back from a business trip, I happened to sit next to a guy who worked for an investment research firm. By the time the flight landed he had suggested I should join them and, at my request, had offered 3 stock tips. I picked one at random and bought it. Over the next several weeks I watched it triple, and by the end of that time I had taken a major pay cut to join the firm in a major mid-career change. Who cared about the salary? The real money would be in the information flow. There I was, surrounded by the exceedingly bright analysts this firm employed. Each focused on 1, maybe 2 industries, and within those industries perhaps 6 to 10 companies and their stocks. More than one had been honored in the trade press as Analyst of the Year for their work. These were folks at the top of their game. They knew each of these industries, and the companies in them, inside and out. They knew the top executives. They knew the middle managers and the front-line people. They knew the customers. They knew the suppliers. They knew the receptionists. They spoke to them all weekly. Sometimes daily. They still didn't get critical information before anyone else, that's insider trading and foolproof, but illegal. But they did know exactly when and how such information would be released. Of course, so did every other competent analyst around the world. Any new information was reflected in the stock price within seconds. They issued reports for which our institutional investor clients paid dearly. And yet, accurately predicting stock performance remained frustratingly elusive. If you've worked in a major corporation it is not hard to see why. The CEO and CFO work with internal forecasts created by their teams. The process looks something like this. Salespeople are required to forecast what their customers will spend. Since these buys are rarely locked in far in advance, and can be cancelled any time, nothing is truly certain. Add to this all the pending business that may or may not come to fruition, and basically you are asking the field salesperson to predict the future. Typically they are not clairvoyant. So, of course, they take a guess. These guesses get passed on to their managers, who are also not clairvoyant, and who now have their own forecasts and decisions to make. Do I take these sales forecasts at face value? Do I adjust them based on knowing Susie is an optimist and Harry always sees dark clouds? So, of course, they too take a guess and pass it on to the next layer of management. So it goes until all these guesses on the inherently unknowable future are consolidated into the nicely packaged budget/forecast binders presented to top management. More often than not, after one look, they'll say, "This is unacceptable. We can't present this forecast to Wall Street. We need more positive results. Go back and revise these numbers." Back down the chain it goes. Maybe multiple times, and each time the numbers get pushed a bit further from reality. Predicting the future is a dicey proposition for even the most gifted psychics, and they are not burdened with this process. Suddenly, my enormous stock-picking hubris was clear. Somehow reading a few books and 10K annual report 7 was going to give me an edge over not only the professional analysts who lived and breathed this stuff all day every day, but also the executives who run the companies in question. I could succeed where they could not. Suddenly I realized why even rock star fund managers find it almost impossible to best the simple index over time. And why more fortunes have been created brokering trades than making them. I cringe at the oft-made suggestion that an investor can read a few books on valuing stocks and go on to replicate Buffett's results. Perhaps the best of these is The Intelligent Investor, written by Warren Buffett's mentor, Benjamin Graham. It is a great book, and if stock analysis interests you, by all means take the time to read it. But remember that when Graham wrote it in 1949, Jack Bogle's first index fund was still 25 years away. Even actively managed mutual funds were few and far between. Analyzing and choosing individual stocks then was a far more necessary and useful skill. But as early as the 1950s, Mr. Graham was warming to the concept of indexing, and by the mid-1970s in interviews was fully embracing its value. The idea that individuals can readily outperform the market is, to steal a phrase from my dad, horse hockey. Dangerous horse hockey at that. People have been trying for decades, and yet, there is still only one Warren. Think about it this way. Remember Muhammad Ali? He was the Warren Buffett of boxing in his day. You and I could have followed his training regimen, maybe even engaged Angelo Dundee to show us the ropes. We could have gotten in top shape, done all our homework, learned the sweet science. And, after all that effort, would you climb in the ring with Joe Frazier or George Foreman or Sonny Liston? Not me. I'm no Ali. Or Warren. Neither are you. Unless of course you are, in which case, thanks for picking up my book. Having read the last chapter, you know what Warren Buffett recommends for individual investors: low-cost, broad-based index funds. Graham, were he still alive, would too. If you choose to try to best the averages, God bless and Godspeed. You may well be smarter and more talented than I. You are most certainly likely to be better looking. I'll look for your name along with Warren's in the not-too-distant future. I extend the same to all those folks I've met in Las Vegas who assure me they have bested the house. I listen, gaze up at the billion-dollar casinos and reflect on how many smarter, more talented and better-looking people there are than me. A little humility goes a long way in saving your ass and your cash. Chapter 26. Why I don't like dollar-cost averaging. At some point in your life you may find yourself in the happy dilemma of having a large chunk of cash to invest. An inheritance perhaps, or maybe money from the sale of another asset. Whatever the source, investing it all at once will seem a scary thing, as we discussed in Chapter 5. If the market is in one of its raging bull phases and setting new records each day, it will seem wildly overpriced. If it is plunging, you'll be afraid to invest, not knowing how much further the fall will be. You risk wringing your hands waiting for some clarity, and, as you know having read this far, that will never come. The most commonly recommended solution is to dollar-cost average, DCA, your way slowly into the market. The idea being that should the market tank, you will have spared yourself some pain. I'm not a fan and shortly we'll explain why, but first let's look at exactly what DCA is. When you dollar cost average into an investment, you take your chunk of money, divide it into equal parts and then invest those parts at specific times over an extended period of time. Let's suppose you have $120,000 and you want to invest in VTSAX. Now, having read this book so far, you know the market is volatile. It can and sometimes does plunge dramatically. And you know therefore that this could happen the day after you invest your $120,000 and, while unlikely, that would make for a very miserable day indeed. So instead of investing all at once, you decide to DCA and thus eliminate this risk. Here's how it works. First, you select a time period over which to deploy your $120,000, let's say the next 12 months. Then you divide your money by 12 and each month you invest $10,000. That way, if the market plunges right after your first investment, you'll have 11 more investing periods that might be better. Sounds great, right? Well, it does eliminate the risk of investing all at once, but the problem is that it only works as long as the market drops and the average cost of your shares over the 12-month investment period remains below the cost of the shares the day you started. Should the market rise, you'll come out behind. You are trading one risk, the market drops after you buy, with another, the market continues to rise while you DCA, meaning you'll pay more for your shares. So which risk is more likely? Assuming you were paying attention while reading parts 1 and 2, you know that the market always goes up but that it is a wild ride. The other thing you know is that it goes up more often than it goes down. Consider that between 1970 and 2013, the market was up 33 out of 43 years. That's 77% of the time. At this point you are probably beginning to see why I'm not a DCA fan, but let's list the reasons anyway. By dollar cost averaging, you are betting that the market will drop, saving yourself some pain. For any given year, the odds of this happening are only 23%. But the market is about 77% more likely to rise, in which case you will have spared yourself some gain. With each new invested portion you'll be paying more for your shares. When you DCA, you are basically saying the market is too high to invest all at once. In other words, you have strayed into the murky world of market timing. Which, as we've discussed, is a loser's game. DCAing screws with your asset allocation. In the beginning you will be holding an outsized allocation of cash sitting on the sidelines waiting to be deployed. That's okay if that's your allocation strategy. But if not, you need to understand that, in choosing to DCA, you've changed your allocation in a deep and fundamental way. When choosing to DCA, you must also choose the time horizon. Since the market tends to rise over time, if you choose a long horizon, say over a year, you increase the risk of paying more for your shares while you are investing. If you choose a shorter period of time, you reduce the value of using DCA in the first place. Finally, once you reach the end of your DCA period and are fully invested, you run the same risk of the market plunging the day after you are done. What to do instead? Well, if you've followed the strategies outlined in Part 2, you already know whether you are in the wealth accumulation or wealth preservation phase. If you are in the wealth accumulation phase, you are aggressively investing a large percentage of your income each month. In a sense, this regular investing from your income is a form of unavoidable dollar cost averaging, and it does serve to smooth the ride. But the big difference is you'll be doing it for many years or even decades to come. And, of course, you don't have the lump sum option. But you are putting your money to work as soon as you get it in order to have it working for you as long as possible. I'd do the same with any lump sum that came my way. If you are in the wealth preservation stage, you have an asset allocation that includes bonds to smooth the ride. In this case, invest your lump sum according to your allocation and let that allocation mitigate the risk. If you are just too nervous to follow this advice and the thought of the market dropping shortly after you invest your money will keep you up at night, go ahead and DCA. It won't be the end of the world. But it will mean that you've adjusted your investing to your psychology, rather than the other way around. Chapter 27. How to be a stock market guru and get on CNBC. Back in the day, Louis Rukeyser hosted a PBS program called Wall Street Week each Friday evening. Watching it was an end-of-the-week ritual for me. He'd open with a commentary on the follies and foibles of the previous market week and then turn to a rotating panel of 3 Wall Street gurus for their take. 2 of my favorites were Abby Joseph Cohen, a relentless bull, and Marty Zweig, who was always deeply worried about this market. Each guest was impeccably credentialed, and Rukeyser made it a point to deftly schedule those who would each week present opposing views as to the market's condition and direction. Sometimes one would even prove right. His commentaries, questions and comments were always delivered with a wink, a smile and with great good humor. Tragically, he passed away in 2006, and the current generation of investors is left without his insights and wisdom. The key thing his program and its parade of guests taught me is that, at any given time, some expert is predicting any possible future that could conceivably happen. Since all bases are covered, someone is bound to be right. When they are, their good luck will be interpreted as wisdom and insight. If their prediction happened to be dramatic enough, it could also lead to fame and fortune. Every January, Rukeyser would have each of his guests predict the market's high, low, and ending point for the year. I forget his exact line, but after the predictions were in, he'd say something like, "With the understanding that even these experts could be wrong, there you have it." And he'd wink into the camera. Come the following December, he'd salute those who'd come closest and chide the goats. All great fun, if not taken seriously. I'd even indulge in making my own annual predictions, but never seriously and never with the idea of using them to get on TV. Even if I turned out to be spot on, mine wouldn't get me interviewed on CNBC. Not dramatic enough. But then, that's not my ambition. If it is yours, however, here's, with my own knowing wink, how. Step 1. Make a prediction for a huge short-term swing in the market. Up or down doesn't matter. But down is easier and scarier. Scarier will get you more play if you're right. Step 2. Document the time and date you made it. Step 3. When it doesn't happen, wait a bit. Step 4. Repeat steps 1 to 3 until one day you're right. Step 5. Issue press release, market plunges, just as, insert your name here, recently predicted. Step 6. Clear your schedule for media interviews. Step 7. Send me my 15% agent's fee of your newfound wealth. Be sure not to issue your press release until events prove you right. Oh, and keep in mind that once your guru status is established, you'll be expected to be able to repeat it. For months, maybe years, everything you say will be noted. Each misstep will be gleefully documented until you slip from view humiliated and discredited. But also rich if you've played your moment in the sun well. Chapter 28. You, too, can be conned. Not too long ago I made an enemy. She is the widow of an old friend. Before he died, I promised to try to look out for her a bit. During a conversation she said I made her feel small. She said I made her feel stupid. There were tears. I'm very likely guilty on both counts. I'm not always tactful. But hopefully, I saved her $2 million. Her husband died a while back. Over the years, he worked hard and had accumulated the aforementioned wealth. He loved his wife dearly and knew he would very likely leave her a widow. The money was an act of love. He wanted to be sure she would be financially secure. But he also knew 3 things that scared him no end. His wife believed in the proverbial free lunch. That is, she was always open to come-ons. Free cell phones were an example. Every time their cell phone contract expired, the provider offered a free cell phone which she proudly grabbed. Somehow she seemed to miss the 2-year contract it locked them into, over and over again. While small potatoes, it was a bad sign. The world is filled with predators looking for people precisely like her. Money and this belief in the free lunch attracts them like sharks to bloody chum. It was this topic of the free lunch that set me off and brought her to tears. I was trying to gently coax her into appreciating the risk financial predators pose. She is a very bright woman and seemed to understand. But then she said, "Don't worry. I can't be conned." "With that you have," I said, and by this point my voice, I fear, was raised, just violated the first rule of not being conned. Make no mistake. You can be conned. So can I. Here's one scam I came across many years ago. Fortunately I read about it. In those days, I might well have taken the bait. It went like this. One day you receive a letter, or maybe these days an email. In it, an investment advisor introduces himself and offers you a stock tip. For example, ABC Corp is going to dramatically rise in price over the next week or two. Don't invest, he cautions, without doing your homework. But his proprietary metrics are pointing to this one as a strong buy. You're no fool, but you decide to maybe keep an eye on it. Just to see. You don't want to miss a good thing. Sure enough, it sharply spikes up. You could have made 50%, 60%, or even 100% on your money in a just couple of days. Damn. Then letter number 2 arrives. This one says BCD Corp is poised to take a sharp fall. Our metrics, it says, say short. Shorting is a way to sell stock you don't own on a bet it will decline in price, this stock. You are a careful investor. Again you decide to watch and see, although with a keener interest now. Sure enough, this one collapses as predicted. Had you acted, big profits would have been yours. Letter number 3 arrives. Then number 4, number 5 and maybe even number 6. Each is dead on. The stock rises, or falls, exactly as predicted. Maybe you even took a chance and profited from 1 or 2. By now, it is hard not to be impressed. Then you get an invitation to dinner at one of your area's finer restaurants. You and a handful of other, executive-level investors, are invited to an informal meeting with Mr. Hasn't Missed One Yet. He'll be discussing his proprietary investment metrics and how they've made him rich. At dinner, Mr. Hasn't Missed One Yet is soft-spoken. He is warm, kind and concerned. He has all the trappings of wealth, but in a tasteful, understated fashion. Charts and graphs are presented. The exact investment approach is unclear, but then it is proprietary. This is to be expected. Oh, and barely mentioned in passing, it just so happens a couple of slots remain open in his latest investment pool. There is certainly no obligation but, of course, based on our experience, they will be snapped up by tomorrow. So, if you are interested. Like all magic, it is of course a trick. Can you spot it? If you can, and this is the first you've come across it, you are sharper than I. But don't get cocky. If not this one, another will arrive and fly under your radar. It can happen to you. Fail to understand this and it inevitably will. That's the first rule. Here's the full set. Rule number 1, everybody can be conned. Certainly stupid people are marks. But so are the exceptionally bright. The moment you start to think that it can't happen to you, you become a most attractive target. The easiest victims are those that think they are too smart, too knowledgeable to be taken. This means you, bucko. Rule number 2, you are likely to be conned in an area of your expertise. The reason is simple, targeting an ego. When con men pick a scam they look for people to whom it will naturally appeal. Those are people in the field. People feel secure and safe in those areas they know well. They believe they will be too smart to be caught unawares. Smart people know the areas they don't know and tend to be far more cautious there. Many of Bernie Madoff's victims were financial professionals. Rule number 3, con men and women don't look like con men. This isn't the movies. They're not going to have slouch hats pulled low over their shifty eyes. Successful con men look like the safest, most trustworthy, honest, stable, comforting people imaginable. You won't see them coming. Or rather you will, and you'll be warmly welcoming them. Rule number 4, 99% of what they say will be true. The best, most effective lies are surrounded by truth. Buried in it. The con, the thing that will leave you broke and with a real reason to cry, is carefully hidden. It is deep in the proverbial fine print. Rule number 5, if it looks too good to be true, it is. There is no free lunch. Not ever. Your mama taught you this. She was right. Listen to your mama. With that said, not all cons are clever. An email from a Nigerian stranger offering you, random old you, millions to accept his money transfer should be obvious. Right? The stranger knocking on your door and offering cut-rate home repairs because we just happen to be working in the neighborhood, but only if you pay in cash up front, is a con man. You know this. Right? Those are the kinds of simple cons my friend's wife was thinking about, and she's right. She is much too smart to fall for them. But those aren't what had her husband worried. It is the clever scammers of the world who seek out the smart, the rich and the lonely. If you have not already done so, have these conversations with your own spouse or partner. Don't leave it to a tactless, although honest, friend of the family like me. Given the actuarial tables and her good genes, my own wife will likely also outlive me by a couple of decades. Since I handle our investments, we have this conversation on a regular basis. We review what we own and why. Fortunately, she understands the principles and their importance. As an aside, this is one more reason I'm a fan of index funds. I want to leave her with a simple portfolio she can leave on autopilot. So far these discussions haven't led to my making an enemy of her. Yet. I think. Oh, and here's how Mr. Hasn't Missed One Yet did it. It is an inverted pyramid. He starts by selecting a very volatile stock and he sends out 1,000 letters. Half predict it will rise and half that it will fall. The 500 that got the correct prediction get letter number 2 with a different volatile stock. The 250 that now have 2 correct predictions get letter number 3 and so on. By letter number 6 you have 15 or 16 marks who have gotten 6 letters in a row with your infallibly accurate predictions. Most will be begging by then to be taken. Part 4. What to do when you get there. Money frees you from doing things you dislike. Since I dislike doing nearly everything, money is handy. Groucho Marx. Chapter 29. Withdrawal rates, how much can I spend anyway? 4%. Maybe more. So, you've followed the simple path big 3. You've avoided debt, you've spent less than you've earned, you've invested the surplus. Now you're sitting on your assets and wondering just how much you can spend each year and not run out. This could be stressful, but it really should be fun. You might even be cheeky enough to ask, what % of his own assets does Jim spend? We'll get to that. You don't have to have read far in the retirement literature to have come across the 4% rule. Unlike most common advice, this one holds up to our beady-eyed scrutiny pretty well, even though it is really very little understood. Back in 1998, 3 professors from Trinity University sat down and ran a bunch of numbers. Basically they asked what would happen at various withdrawal percentage rates to various portfolios, each with a different mix of stocks and bonds, over 30-year periods depending on what year the withdrawals were started. They ran their scenarios both adjusting withdrawal levels for inflation and not adjusting the withdrawal. Phew. Then they updated it in 2009. Out of the scores of options in the study, the financial media seized on just one of these models, the 4% withdrawal rate, 50/50 stock/bond portfolio, adjusted for inflation. Turns out, 96% of the time, at the end of 30 years such a portfolio remained intact. Put another way, there was just a 4% chance of this strategy failing and leaving you destitute in your old age. In fact, it failed in only 2 of the 55 starting years measured, 1965 and 1966. Other than those 2 years, not only did it work, many times the remaining money in the portfolio had grown to spectacular levels. Think about that for a moment. What that last line means is that in most cases the people owning these portfolios could have taken out 5, 6, 7% per year and done just fine. In fact, if you gave up the inflationary increases and took 7% each year, you would have done just fine 85% of the time. Most of the time taking only 4% meant. At the end of your days you left buckets of money on the table for your all too often ungrateful heirs. Great news, were that your goal. Also great news if you anticipate living on your portfolio for longer than 30 years. But the financial media believes that most people don't like to think too hard. By reporting the results at 4% they could report on just about a sure thing. Roll it down to 3% and we have as sure a thing as we'll ever see short of death and taxes. And that's giving yourself annual inflation increases. While 1965 and 1966 were the last and only 2 years where 4% failed, remember that more recent start years have not yet had their own 30-year measurable runs. My guess is that if you began your own withdrawals in 2007 and the early part of 2008 just prior to the collapse, you will have hit upon 2 more years in which the 4% plan is destined to fail. You'll want to scale back. On the other hand, if you started with 4% of your portfolio's value as of the March 2009 bottom, you're very likely golden. If you are curious, here's an overview of the Trinity study you can read for yourself. http://www.nfpowerg/journal/pages/portfolio%success%traits%w http://www.nfpowerg/journal/pages/portfolio%success%traits%w here %20 to %20 draw %20 the %20 line.aspx. In summary, withdrawing 3% or less annually is as near a sure bet as anything in this life can be. Stray much further out than 7% and your future will include dining on dog food. Stocks are critical to a portfolio survival rate. If you absolutely, positively want a sure thing and your yearly inflation raises, keep your withdrawal rate under 4%. And hold 75% stocks/25% bonds. Give up those yearly inflation raises and you can push up towards 6% with a 50% stock/50% bond mix. In fact, the authors of the study suggest you can withdraw up to 7% as long as you remain alert and flexible. That is, if the market takes a huge dive, cut back on your withdrawals and spending until it recovers. If you review the study you'll see it has 4 tables. Tables 1 and 2 look at how various portfolios performed over time and at various withdrawal rates. Tables 3 and 4 tell us how much money remains in the portfolios after the 30 years have passed. The difference between them is that tables 2 and 4 assume the dollar withdrawal amount is adjusted each year to account for inflation. Let's take a look. So if you look at table 1 and at the 50-50 mix with a 4% withdrawal rate, you see you have a 100% chance of your portfolio surviving 30 years. Table 2 tells you that if you take those same parameters but give yourself inflation raises, your portfolio's chance of survival drops to 96%. Makes sense, no? Tables 3 and 4 tell us how much money remains in the portfolios after the 30 years have passed, and this, to me, is really compelling stuff. Again, Table 3 assumes a straight percentage withdrawal and Table 4 assumes giving yourself inflation raises. Let's take a look at some examples. Assuming a 4% withdrawal rate on a portfolio with an initial value of $1 million, here's what you'd have left, median ending value, after 30 years, from Table 3, without inflation-adjusted withdrawals. 100% stocks equals $15,610,000. 75% stocks / 25% bonds equals $10,743,000. 50% stocks / 50% bonds equals $7,100,000. From Table 4, with inflation-adjusted withdrawals. 100% stocks equals $10,075,000. 75% stocks / 25% bonds equals $5,968,000. 50% stocks / 50% bonds equals $2,971,000. This is very powerful stuff, and it should give you a lot to feel warm and fuzzy about as you follow the simple path to wealth. As you look over these tables, one thing that should become very clear is just how powerful and necessary stocks are in building and preserving your wealth. This is why they hold center stage in the simple path to wealth. What is likely less obvious, but every bit as important, is the critical importance of using low-cost index funds to build your portfolio. When you start paying 1 to 2% fees to active mutual fund managers and/or investment advisors, all these cheerful assumptions wind up in the trash heap. Wade Pfau, professor of retirement income at the American College for Financial Services and one of the most respected observers of the Trinity study, says it best. For an example of this, the 50-50 portfolio over 30 years with 4% inflation-adjusted withdrawals had a 96% success rate without fees, 84% success rate with 1% fees, and 65% success rate with 2% fees. In other words, using the Trinity study projections with portfolios built from anything other than low-cost index funds is invalid. So, now to answer that question we alluded to earlier, what withdrawal percentage do I personally use in my retirement? I confess I pay so little attention it took a few moments to figure it out, and even once I did, it wasn't exact. But my best guess is for the last few years it has run somewhere north of 5%. This casual approach may surprise you. But there are mitigating circumstances. I had a kid in college. That is a huge annual expense, but as of the spring of 2014, it has gone away. During her college years, the money for it was figured into my net worth, but it was also earmarked as spent. Since my retirement, my wife and I have accelerated our travels and the related spending has spiked sharply. Not to be morbid, but at my age I am more worried about running out of time than money. If the market were to tank in a major way, this is an easy expense to adjust. Sometime in the next few years we will have 2 nice new income streams coming online in the form of Social Security. Most importantly, I know I'm well under the 6 to 7% level that requires close attention. Given the above, going forward my guess is it will drop to under 4%. Within that 3 to 7% range, the key to choosing your own rate has less to do with the numbers than with your personal flexibility. If as needed you can readily adjust your living expenses, find work to supplement your passive income and/or are willing and able to comfortably relocate to less expensive places, you will have a far more secure retirement no matter what rate you choose. Happier too, I'd guess. If you are locked into certain income needs, unwilling or unable to ever work again, and your roots go too deep to ever seek out greener pastures, you'll need to be much more careful. Personally, I'd work on adjusting those attitudes. But that's just me. 4% is only a guide. Sensible flexibility is what provides security. Chapter 30. How do I pull my 4%? At some point, if you have been following the simple path described in this book, you will be able to choose to have your assets pay the bills rather than your labor. How quickly you reach this point will have much to do with your savings rate and how much cash flow you require. In any event, your assets will have reached the point where by providing 4% as discussed in the last chapter, they can cover all your financial needs. Or said another way, your assets now equal 25 times your annual spending. Having left your employment, you will have rolled any employer-based retirement plans, such as a 401k, into your IRA, and the investments themselves will be split between stocks and bonds held in the allocation that best matches your personal risk profile. Ideally, these will be in Vanguard's low-cost index funds, VTSAX for stocks and VBTLX for bonds. As we discussed in Chapter 19, these two funds will be in your tax advantaged and ordinary, taxable, buckets. By this time you will have pared these down to just 3, IRA, Roth IRA, and taxable. My suggestion, and personal portfolio, is to hold them as follows. VBTLX in the IRA, as it is tax inefficient. VTSAX in the Roth IRA, because this is the last money I would spend and the money most likely to be left to my heirs. Roths are an attractive asset to leave upon your death, and, since this is my most long-term money, the growth prospects of VTSAX make it the preferred investment here. VTSAX also goes into the taxable account because, of the two funds, it is more tax efficient. VTSAX is also held in our regular IRAs, as even it can benefit from tax deferral. As you can see, if you are single you will actually have 4 fund accounts, VBTLX in your IRA and VTSAX held in all 3 places, Roth, IRA, and taxable. If you are married, your allocation might look something like ours. I hold VTSAX in my Roth and in my regular IRA. Our entire bond allocation in VBTLX in my regular IRA. My wife holds VTSAX in her Roth and in her regular IRA. Jointly we hold VTSAX in our taxable account and minimal cash for spending needs in our savings and checking accounts. So together we have 2 Roths, 2 IRAs and 1 taxable account. Across these we have 1 investment in VBTLX and 5 in VTSAX. Our allocation is 75/25, VTSAX/VBTLX. It is also very possible that, even if you've embraced the simple path in this book, you still have other investments. If these are in your tax-advantaged accounts you've likely rolled them tax-free into Vanguard. But if they are in taxable accounts, the prospect of a hefty capital gains tax might have persuaded you to hold on to them. When I retired, we also had some of these cats and dogs, mostly in the form of individual stocks I had yet to break the habit of playing with. At this point the discussion risks becoming a bit complex. There is almost an endless array of ways you might withdraw the 4% you'll be spending from your investments. So, let's start with the mechanics of how this works and then I'll share with you some guiding principles and exactly what we are doing and why. From there, you should have the tools you need to form your own strategies. Mechanics. If you hold your assets with Vanguard, or any similar firm, the mechanics of withdrawing your money could not be easier. With a phone call or a few clicks online, you can instruct them to transfer a set amount of money from any of your investments on whatever schedule you choose, weekly, monthly, quarterly, or annually. Transfer any capital gains distributions and/or dividends and interest as they are paid. You can log on their website and transfer money with a few clicks anytime. Or any combination of these. This money can be transferred to your checking account or anywhere else you choose. The process couldn't be much easier than a phone call to Vanguard, and likely most any other firm, will get you friendly and helpful assistance in walking through it all the first time. Principles. Next, let's look at some of the guiding principles behind the approach we use. First, notice that in constructing our 75/25 allocation, we look at all of our funds combined, regardless of where they are held. Second, we have all our dividends, interest and capital gains distributions in our tax-advantaged accounts reinvested. I am not captivated by the idea of living only off the income, that is, dividends and interest, as many are. Rather, I look toward drawing the 4% the research has shown a portfolio like mine can support. Third, we have the dividend and capital gains distributions from VTSAX in our taxable account sent directly to our checking account. Since the payment of these is a taxable event, it makes no sense to reinvest them only to turn around and withdraw the equivalent amount of money shortly thereafter. Fourth, I want to let my tax-advantaged investments grow tax-deferred as long as possible. Fifth, as I am within 10 years of age 70 and a half, I want to move as much as I can from our regular IRAs to our Roths, consistent with remaining in the 15% tax bracket. You'll recall this strategy from our discussion on RMDs. Required minimum distributions, in Chapter 20. Sixth, once we hit age 70 and a half and are faced with RMDs, these withdrawals will replace those we have been taking from our taxable account. The taxable account will then be left to grow again. Pulling the 4% in action. 1. First, we think about the non-investment income we still have coming in. Even once you are retired, if you are actively engaged in life, you might well also be actively engaged in things that create some cash flow. We are no longer in a savings mode, but this earned money is what gets spent first. And to the extent it does, it allows us to draw less from our investments and allows them in turn still more time to grow. 2. Remember those cats and dogs I had left over in our taxable accounts? Upon entering retirement, those were the first assets we spent down. We started with the ugliest ones first. While you may or may not choose to follow the rest of our plan, if you have such remnants left in your own portfolio, I strongly suggest this is how you offload them. Do it slowly, as needed, to minimize the capital gains taxes. Of course, if you have a capital loss in any of them, you can dump them immediately. You can then also sell some of your winners, using this capital loss to offset those gains. You can use up to $3,000 per year of these losses to offset your earned income. Any tax loss you can't use you can carry forward for use in future years. 3. Once those were exhausted, we shifted to drawing on our taxable VTSAX account. We will continue to draw on this account until we reach 70 and a half and those pesky RMDs. 4. Since the taxable VTSAX account is only a part of our total, the amounts we now withdraw each year far exceed 4% of the amount in it. The key is to look at the withdrawals not in terms of the percent they represent of this one account, but rather in the context of our entire portfolio. 5. We could set up regular transfers from the taxable VTSAX as described above, but we haven't. Instead, my wife, who handles all our day-to-day finances, simply logs on to Vanguard and transfers whatever she needs whenever she notices the checking account getting low. 6. This withdrawal approach may seem a bit haphazard, and I guess it is. But as explained in the last chapter, we don't feel the need to obsess over staying precisely within the 4% rule. 7. Instead, we keep a simple spreadsheet and log in our expenses by category as they occur. This allows us to see where the money is going and to think about where we might cut should the market plunge and the need arise. 8. Each year I calculate what income we have and, consistent with remaining in the 15% tax bracket, I shift as much as I can from our regular IRAs to our Roths. This is in preparation for the RMDs coming at age 70 and a half. When that time comes, I want our regular IRA balances to be as low as possible. 9. Once we reach age 70 and a half, we will stop withdrawing from our taxable account and let it alone again to grow once more. Instead, we will start living on the RMDs that now must be pulled from our IRAs under the threat of a 50% penalty. 10. While I'm fairly certain the money in our taxable account will last until we reach 70 and a half, if it were to run out we'd simply begin drawing money from our IRAs ahead of the RMDs. In essence, this would be the money I had been shifting into the Roths. And, again, I'd strive to keep what we withdrew consistent with staying in the 15% tax bracket. 11. Despite my efforts to lower the amounts in our regular IRAs, the RMDs, once we are both forced to take them, will likely exceed our spending needs. At this point we will reinvest the excess in VTSAX in our taxable account. There you have it. While you could, you don't have to follow this exactly. You are free to adapt what works best for your situation and temperament. For instance, if the idea of touching your principal goes against your grain and you want to spend only what your investments earn, you can instruct your investment firm to transfer all your dividends, interest and capital gain distributions into your checking account as they are paid. Since all these together will likely total less than that 4% level, should the need arise, you could occasionally log on and simply transfer some more money by instructing that a few shares be sold. Or have your dividends, interest and capital gains transferred as they are paid and scheduled transfers from your taxable account on a regular basis to bring the total up to 4%. For example, if you had $1 million in your portfolio allocated 75/25 stocks and bonds. At 4% your withdrawals equal $40,000, your $750,000 in VTSAX earns 2% dividend, or $15,000 your $250,000 in VBTLX earns 3% interest, or $7,500 that totals $22,500, and if that's all you need, you're done. But if you want the full $40,000, the remaining $17,500 you'd withdraw by selling shares from your taxable account. Taken monthly it would be $1,500. This seems overly cumbersome to me and I present it only to illustrate how someone focused on living on only their investment income might approach things. Here's what I would not do. I would not set up a 4% annual withdrawal plan and forget about it. As we saw in the last chapter, the Trinity study set out to determine how much of a portfolio one could spend over decades and still have it survive. Adjusting each year for inflation, withdrawals of 4% annually were found to have a 96% success rate. This became the 4% rule designed to survive the vast majority of stock downturns so you wouldn't have to worry about market fluctuations in your retirement. It made for a great academic study and it is heartening that in all but a couple of cases the portfolios survived just fine for 30 years. In fact, most of the time they grew enormously even with the withdrawals taking place. Setting aside that in a couple of the scenarios this approach would leave you penniless, in the vast majority of cases it produced vast fortunes. Assuming you neither want to be penniless or miss out on enjoying the extra bounty your assets will likely create, you'll want to pay attention as the years roll by. This is why I think it is nuts to just set up a 4% withdrawal schedule and let it run regardless of what happens in the real world. If markets plunge and cut my portfolio in half, you can bet I'll be adjusting my spending. If I was working and got a 50% salary cut I would, of course, do the same. So would you. By the same token, in good times I might choose to spend a bit more than 4% knowing the market is climbing and that provides a strong wind at my back. Either way, once a year I'll reassess. The ideal time is when we are adjusting our asset allocation to stay on track. For us, that's on my wife's birthday or whenever the market has had a 20% plus move, up or down. True financial security, and enjoying the full potential of your wealth, can only be found in this flexibility. As the winds change, so will my withdrawals. I suggest the same for you. Chapter 31. Social Security, How Secure and When to Take It. Back in the early 1980s I remember railing against Social Security to my mother, who was on it. She'd grown up with the specter of little old ladies living on cat food. That was a real possibility when she was a girl and the elderly were the poorest group in America. I explained to her that if I and my two sisters were let off the SS hook we could not only give her more than her monthly check, we'd have extra left to feather our own nests. She wasn't buying it. And I wasn't buying it either. I never figured Social Security would be there for me. All my financial planning has been based on the idea that if it wasn't, no problem. If it was, that would be a pleasant surprise. Well, surprise. Now I'm just a few short years from collecting, and a surprisingly hefty amount at that. Considering what we've paid in and assuming we live long enough, it turns out to be a pretty sweet deal. I hadn't counted on the power of the AARP, the most formidable lobby in history. Social Security was born in 1935 during the depths of the Great Depression. Those hard times devastated almost everybody, but none more perhaps than the elderly who were no longer able to work even in the unlikely event work might be found. Many were literally living on cat food, if that could be had. Back in those days, life expectancies were considerably lower. Figuring this can be tricky as the biggest reducer of average life expectancy is deaths in childhood. But if we look at the life expectancies of people who have survived to the age of 20, we get a more useful number. In 1935, for men the average was around 65, for women about 68. Since then, life expectancy in the US has continued to expand. As of 2013, according to the World Health Organization, it is now 77 for men and 82 for women. From those numbers it's easy to see that setting the age to collect Social Security at 65 was a pretty good bet for the system. All workers would pay in, but relatively few would live long enough to collect, and those who did would only collect for a few years. This worked so well, in fact, with some fairly minor adjustments along the way, that it was only around 2011 that the money flowing in stopped amounting to more than the money being paid out. So well, the total surplus reached $2.7 trillion by 2011. But as you can also see, now the wheel has turned. The huge baby boom generation that has been paying in these surpluses has begun to retire. In addition, they are living a whole lot longer. Going forward, if nothing changes, the system will be paying out more than it takes in. It looks like this. 1935 to 2011, annual surpluses build and end up totaling about $2.7 trillion. 2012 to 2021, annual payroll taxes fall short of the annual payouts. But the 4.4% interest on the $2.7 trillion will cover the gap. 2021 to 2033, the interest payments will no longer be enough to make up the payout difference and will start drawing down on the $2.7 trillion. 2033, the $2.7 trillion is gone. After 2033, the payroll taxes then collected will only be enough to cover 75% of the benefits then scheduled to be paid out. Where exactly is this $2.7 trillion? The $2.7 trillion surplus is commonly referred to as the trust fund, and it is held in U.S. Treasury bonds. This, as of 2012, by the way, is about 16% of the roughly $16 trillion U.S. debt. In a real sense, we owe it to ourselves. In fact, about 29%, $4.63 trillion, of our $16 trillion debt is owed to ourselves in this fashion: Social Security, Medicare, and the balance in military and civil service retirement programs. Only $1.1 trillion / 8.2% is owed to China, our top foreign creditor and the one we hear most about. We owe Japan about the same. As of 2016, the total U.S. debt is now over $19 trillion. Does this $2.7 trillion really even exist? You've probably heard scary talk that this trust fund doesn't really exist. That the government has already spent the money. Well, yes and no. There is no lockbox somewhere stuffed with $100,000 bills. These were printed in 1934 and commonly called gold certificates. Woodrow Wilson was the portrait on them. They were only used by the government for official transactions between Federal Reserve banks and were never available to the public. The trust fund is in a whole bunch of U.S. Treasury bonds. To answer the question, is the money really there, you need to understand a bit about what these bonds are and how they work. Anytime any entity sells a bond, it is to raise money it intends to spend. The bond and its interest are then paid back with future revenues. As it happens, U.S. Treasury bonds, what the trust fund holds, are considered the safest investments in the world. Backed, as the saying goes, by the full faith and credit of the United States government. Of course, that's us, the US taxpayers and the same folks owed most of the $2.7 trillion. So the US Treasury bonds held by the trust fund are real things with real value, just like the US Treasury bonds held by the Chinese, the Japanese, numerous bond and money market funds and countless numbers of individual investors. Yeah, but I'd still feel better if they hadn't spent the money I contributed and if it really was cold hard cash in a lockbox I could draw on. Well, okay, but cash is a really lousy way to hold money long term. Little by little inflation destroys its spending power. It is important to understand that any time you invest money, that money gets spent. If you hold a savings account at your local bank, your money isn't just sitting in a vault. The bank has lent it out and is earning interest on it. It is not all instantly available. If that is an unacceptable risk, your alternative is to stuff your cash in your mattress or a safe deposit box. Had the government done that, the trust fund would now be overflowing with currency. That is, pieces of paper money backed by, you guessed it, the full faith and credit of the United States government. At least the Treasury bonds pay interest. When should I begin taking the money? Once you reach age 62, you can begin receiving Social Security. The catch is, the sooner you start, the smaller your checks. The longer you delay, up until age 70, the bigger the checks. Of course, the longer you delay the fewer the years you'll be collecting. Countless articles have been written about strategies attempting to answer the question as to when to begin receiving benefits. All kinds of fancy, sometimes complex strategies, are described. I've read a bunch and my view is in the end it's really pretty simple, since the government actuarial tables are as good as they get, the payments are pretty much spot on with the odds. Here's what, in order, you have to ask yourself. When do I need the money? If you genuinely need the money right now, nothing else matters. But each month you delay, your monthly check gets bigger. Do you think Social Security will collapse and stop paying? If you believe this, clearly you'll want to collect while the collecting is good. For what it's worth, I happen to think you're wrong and I'll explain why further on. How long are you going to live? The longer you live, the more advantageous delaying is. The break-even point between age 62, 66 is around age 84. That is, if you live longer than 84 you will collect more in total by delaying your benefit until past age 66. If you think you'll die before 84, you might want to take the money sooner. Unless you are married and you were the higher earning spouse. Then you also want to consider how long your spouse will live. If your spouse is likely to outlive you, upon your passing she will be able to trade in their lower Social Security payments for your bigger checks. For example, my wife and I are both in good health. But looking at family histories, and because women usually outlive men, my best guess is that she'll survive me. I figure I'm good to maybe 80 to 85. Were I alone, I'd start drawing ASAP. But she could easily see 95 or 100. When I die she'll have the option of switching from her benefit to mine. Since mine will be larger, that's what she'll do. To maximize that check for her, I'll delay taking my benefit until I'm 70. She'll start hers at 66. Another thing worth considering, as we reach advanced age our mental acuity diminishes. Managing our investments becomes harder. We become more reliant on others. At that point, a reliable monthly government check has more value than just the dollars. Of course there's no way to know what the future really holds. The best we can do is play the odds. But Social Security is doomed. I'm taking mine ASAP. There are those who choose to take their benefits the moment they turn 62, even though the amount is reduced. Some simply need the money right now and have no choice. But others are acting out of fear. They believe Social Security will collapse in their lifetime and they want to get what they can while they can. I'm not worried. If you are 55 or older you'll collect every dime. Here's why. Social Security is backed by the most powerful lobby in history, AARP. Geezers are an increasing proportion of the population. Geezers vote. Politicians rarely try to take anything away from a large population that votes. This is why all the possible solutions being suggested thus far affect only those age 55 and under. Well, that's all well and good, but I'm underage. 55. What about me? For anyone 55 and over, Social Security has turned out to be a pretty great deal. But my generation and the generations older than I are likely the last that will enjoy such lofty benefits. The system is in trouble and clearly changes will have to be made. For those under 55 today, the deal is likely to be a lot less sweet. You can expect to get 100% of any promised benefits, but the promises will be smaller. It will cost you more. Income caps, the amount of your income subject to Social Security tax, will continue to be raised. In 2003 the cap was $87,000. In 2013 it was $113,700. That's a trend that will continue. The full retirement age will continue to rise. It used to be 65. For me it's 66. For anybody born in 1960 or later it is 67. Those ages will continue to rise. Benefits may become means tested. That is, based on your need rather than what you paid in. Congress will continue to tinker and in the end Social Security will still be there. So, is Social Security a good deal? Well, it kinda depends. For the fiscally responsible types reading this book, probably not. If you took that 7.65% of your income you are compelled to contribute, along with the 7.65% your employer is compelled to kick in, as of 2015, and invested it over the decades using the strategies presented here, you'd likely be far, far ahead. Plus your money would be in your hands and not subject to the whims of the government. But that's just the few of us. I'm realistic enough to know most people are goofs with their money. Without Social Security many would be back to living on cat food. Not only would the rest of us have to read about their sad plight, something much more draconian than Social Security might well be implemented to remedy the situation. So, yes, for most people it will turn out to be a good deal. And probably for society as a whole. But not for you. Or me. My recommendation. Plan your financial future assuming Social Security will not be there for you. Live below your means, invest the surplus, avoid debt and accumulate FU money. Be independent, financially and otherwise. If, when Social Security comes through, enjoy. Want to know where you personally stand with Social Security right now? Go here, http://ssa.gov/myaccount/http://ssa.gov/myaccount. This is the Social Security website and, once you create an account for yourself, you'll be able to track where you stand. You'll also be able to check and make sure that the record of your earnings is accurate. This is very important as the size of your checks will be in part determined by how much you earned over the years. Chapter 32. How to Give Like a Billionaire. I know what you're thinking. For some time now you've been wondering what exactly Mrs. Collins and I have in common with Bill and Melinda Gates. Here it is. We both have charitable foundations. Now you're thinking, I knew it. Jim is a billionaire. In this you'd be, sadly I must say, mistaken. More monk than minister, I'm afraid. We don't even have a fancy Gates-like building to house it in. We've talked a lot about investing and building your own FU money, but virtually nothing on, well, spending it. Since we personally don't much care for owning things, I've not much to say. We like to travel. We do spend on that. Sending our daughter to college was money well spent, as she so thoroughly embraced the experience. But the money we've spent that has provided us with the most pure personal pleasure is that we've been privileged to give away. In fact, I can specifically pinpoint the $1,200 that has given us the most satisfactory return of all. I hesitate telling this story as it will be easy to read it as bragging when it's only meant to illustrate a point. I hope you take it in that spirit. Many years ago we attended a charitable auction held by the Catholic grammar school our daughter then attended. We had always been impressed with the teachers and the Mother Superior who ran the place. One of our favorite local restaurants was called Parker's, after the chef who owned it. On this occasion Parker had donated for auction a gourmet dinner for 10. On the spur of the moment we decided to win it and gift it to the school's teachers. Bidding was spirited, but as the amounts reached the actual cost of dinner for 10 at Parker's, the competition dropped off. At around $1,200 we were the winners. When I gifted it to the Mother Superior I also gave her two obligations. First, she would have to choose which 10, of the 15 total, teachers would get to go. Second, she herself would have to attend. See, we knew this Mother Superior and needed to head off her selfless ways. When word spread, a couple of very interesting things happened. Parker himself stepped up and expanded his donation to dinner for 15 so everyone got to go. Another bidder offered to foot the bill for the wine. Well, you know what happens when you mix fine food, wine and Catholic school teachers. Let's just say a good time was had by all, and leave it at that. In addition to personal pleasure, one of the benefits of charitable giving is the tax deduction. Of course, to gain this benefit you must itemize your deductions on your tax return. For instance, if you are married and filing jointly, you are allowed a standard deduction of $12,600 in 2015. Should you have less than that in itemized deductions, you are better off taking the standard deduction and saving yourself the effort. A few years ago it occurred to me that two life changes were coming down the pike that would affect my personal tax situation. We were planning to sell our house and I was planning to retire. Without the house and its associated deductible costs we'd no longer be itemizing. Upon retiring I'd be in a lower tax bracket. Both these things would lower the tax advantage of charitable giving. The solution: the J.J. Collins Charitable Fund. You already know I'm a huge fan of Vanguard. So it should be no surprise that in setting up our foundation we used the Vanguard Charitable Endowment Program. Here's why. You don't have to be a billionaire. You can open your own foundation with as little as $25,000. Fancy building not included. You get the tax deduction in the year you fund your foundation. So I got to take the tax benefits when they mattered most to me. If you have stocks, mutual funds or other assets that have appreciated in value, you can move these directly into your charitable foundation. You get the tax deduction for their full market value and you don't have to pay any capital gains taxes on the gain. Double tax win and more money for your charities. If you are faced with the RMDs we discussed in Chapter 20, you can roll all or part of a tax-advantaged account directly into your charitable foundation tax-free. You can choose a variety of investment options so your donation grows tax-free while waiting for you to allocate it. You decide which charities receive your money, how much, and when. You can set this up to happen automatically. You can add more money to your foundation whenever you choose. If your balance falls below $15,000 you will be charged an annual $250 account maintenance fee. Because it is run through Vanguard, expenses are rock bottom. Now I can tell unwanted solicitors, we only give through our foundation. Please send us your written proposal. We've gotten exactly 0 proposals. It keeps our personal names off the list some charities sell to other solicitors. In addition to the tax advantages this offers, it also plays into some of my personal conclusions regarding charitable giving. It is best to concentrate your giving. We have selected just 2 charities. Giving small donations to many charities might be satisfying to you, but it dilutes the impact and a greater percent of your gift is eaten up in the processing of it. Many small donations also gets you on many mailing lists. Never give to phone solicitors. The more I see at charity advertising, the less likely I am to believe they are focused on delivering my cash to those they claim to serve. You need to do your homework. In addition to scams, many charities simply aren't very efficient in delivering your dollars to those in need. Several websites vet charities. This is the one I've used: www.charitynavigator.org. www.charitynavigator.org. You don't need a charity to help. There is also something to be said for giving outside the traditional, and tax-deductible, places. Helping your friends and neighbors directly isn't deductible, but it has immediate benefits all around. This is something I'll be trying to do more of in the coming years, especially since I'm not currently itemizing my deductions. Finally, while giving is a fine and pleasant thing, no one has an obligation to do so. Anyone who tells you differently is trying to sell you something, most likely the idea of giving to them and/or their pet projects. As individuals, we only have one obligation to society: to ensure we, and our children, are not a burden to others. The rest is our personal choice. Make your own and make the world a far more interesting place. Afterward. Everything you want is on the other side of fear. Jack Canfield. Chapter 33: My Path for My Kid, the First 10 Years. My daughter recently graduated from college. This is the early life financial path I suggest to her. But you don't have to be just out of college or in your 20s to implement this plan. If you are older and looking to make a change toward wealth, think of it as a 10-year plan. Avoid debt. Nothing is worth paying interest to own. Avoid fiscally irresponsible people and certainly don't marry one. Spend the next decade or so working your ass off building your career and your professional reputation. This is not meant to suggest you must be some sort of office drone. Think of your career in the most expansive of terms. The possibilities are endless. Take those low-cost college living skills you've honed and use them to pursue any number of new adventures. Don't get trapped by an expanding lifestyle or unwind it if you already are. Save and invest at least 50% of your income. Put this in VTSAX or one of the other options we've discussed in this book. Fund any 401(k) type employer tax-advantaged plan you are offered. Fund your Roth IRA when your earnings and the income taxes on them are low. Fund your traditional IRA once your earnings and the income taxes on them begin to rise. Do this for the next 10 years or so and you'll be well on your way to financial independence. Save more than 50% and you'll get there sooner. Save less and it will take a bit longer. If you get lucky with the market, you'll get there sooner. If not, it will take a bit longer. During this accumulation phase, celebrate market drops. While you are in the wealth accumulation phase, these are gifts. Each dollar you invest will buy you more shares. But never fall prey to thinking you, or anyone else, can anticipate or time these drops. Sometime in your early to mid-30s, or 10 to 15 years after you start, two things will happen: your career will be hitting its strongest surge and you will be closing in on financial independence. Once 4% of your assets can cover your expenses, consider yourself financially independent. Put another way, financial independence equals 25x your annual expenses. That is, if you are living on $20,000, you have reached financial independence with $500,000 invested. If, like our friend Mike Tyson used to, you are living on $400,000 a month / $4.8 million a year, you're going to need $120 million. As you can see, being financially independent is every bit as much about controlling your needs as it is about building your assets. Once you are financially independent, begin living on your investments. At the point you become financially independent, you can decide if you are still having fun and want to continue your career or try something new. If you keep working, invest 100% of your earnings. You are living on your investments now. This will dramatically accelerate the growth of your assets. Note, you don't have to implement these last 3 points literally. Rather, this is a way to think about your assets and income. Most likely, in executing this concept you will want to spend from your earned income while keeping your investments intact and adding to them. This growth of your assets will, in turn, accelerate the growth of the spendable dollar amount 4% represents. As long as you are working, VTSAX can serve all your investing needs. The money you add along the way will smooth the ride. Once you decide you are done working, diversify into bonds. The more bonds you add, the smoother the ride but the lower the growth. Once you've reached financial independence and are able to live on 4% of your holdings, should you so choose, now is the time to begin expanding your lifestyle. Just be sure to keep your spending level at 4% of your holdings. To think about giving like a billionaire as we discussed in Chapter 32. To have children, if you plan to. You are still plenty young enough, financially secure, and with financial independence you can arrange your affairs in such a fashion as to give them the time they deserve. To consider buying a house, if you are so inclined. But don't be in a hurry. Houses are not investments, they are expensive indulgences. Buy one only when you can easily afford it and if it provides the lifestyle change you want. You're young, smart, healthy, and tough. By your 30s you'll have FU money and you should have a blast getting there. Once you've got it, it will continue to expand, as will your personal options. Your future is so bright it hurts my eyes to look at it. That's what I have told and will continue to tell my daughter. So, if you are also in college or a few years out and wanted to know what your kindly old Uncle Jim suggests, there you have it. Like everything we've discussed, it is all about expanding your opportunities in life. If you are a bit more seasoned, don't despair. It's never too late. It took me decades to figure this stuff out. Like mine, your road has likely already had more bumps than those who follow this path from the start will endure. But those bumps are in the past. It is your future that matters, and that starts, for all of us, right now. Chapter 34. Tales from the South Pacific. One day many years ago I was having an especially bad day at work. Late in the afternoon I called my not yet then but soon to be wife and said, "I'm sick of this crap. Let's quit our jobs and run away to Tahiti." I'm not entirely sure I knew where Tahiti was at the time. She said, "Sounds good. I can get a deal on the airfare." 2 weeks later a lovely Tahitian girl was hanging a welcoming lei around my neck and I was learning I'd need to be careful what I suggested around this woman I had proposed to marry. Mook. Tahiti is a collection of islands in the South Pacific, each seemingly more stunning than the last. On one of these we stayed for a while in a hut built over the crystal clear water. One morning, lingering over coffee in the outdoor cafe on the grounds, a trim, athletic fellow came up to our table. He was barefoot and shirtless. He introduced himself as Mook, one of the hotel owners. An obvious American by his accent. Exceedingly curious, of course we invited him to join us. Mook is a great conversationalist and storyteller. He began by confessing he had noticed my not yet then wife lounging about the day before and had almost upbraided her for slacking in her duties. "She very much looks like a Tahitian." All very amusing, but not answering my burning question. "So," I said, "how exactly does a guy from the US wind up owning a hotel in Tahiti?" Turns out Mook and 2 of his pals had graduated from university somewhere in Michigan in the early 1960s. From there they moved to California. Casting about for something to do, one of them noticed a small classified ad offering a pineapple plantation for sale in Tahiti. Dirt cheap. Remember, Tahiti had yet to become a famous tourist destination. They bought it sight unseen and began packing their bags. I said, "Did you know anything about pineapple growing?" "Not a thing," said Mook. Did you grow up on a farm? Nope. We were all city kids. But surely you worked on a farm while going to school. Never even set foot on one. They get to Tahiti and go to work on their pineapple plantation. Within a couple of months it becomes clear why it was dirt cheap. Turns out you can't actually make a living growing pineapples in Tahiti. Broke and getting broker, stranded in paradise, they began to wonder about their options. That's when the local bank in Papeete invites them to a meeting. Seems down the hill from the plantation on the water is a half-built hotel. The builder has bellied up and given up. Would Mook and his pals, the bank asks, be willing to finish it? Generous terms, of course. Wait a second, I said, did you guys have any construction experience? Not a bit. But you'd run a hotel before then, right? Nope. Worked in one? Never. But we had stayed in some occasionally. So why in hell, and I mean this in the most pleasant possible way, I said, would a bank gift a half-finished hotel and construction loans to you guys? Their back was against the wall and we were Americans. Americans had a reputation for getting things done. Mook and his pals lived up to that reputation. Despite their lack of experience, they got the hotel finished and operating profitably. Then they went on to build and operate others, including the one where we stayed. By the time we met he was rich, barefoot, shirtless and getting richer. Oh, and living in paradise to boot. By the way, in writing this I got to wondering about Mook and Googled him. Turns out he's now 80 and going strong. Some of his story details are different than I recall and have presented here, but clearly we weren't the only ones upon whom he made an impression. But Mook was not the only person in Tahiti we met who had managed to put life together on their own terms. Over dinner. One evening we wandered down the beach to a little place on the sand for dinner. Out in the bay there were several beautiful sailboats. While we were having drinks, a dinghy detached from one of the boats and made its way to shore. A couple about our age, late 20s at the time, got out, walked up the sand and took the table next to us. We got to talking. Soon we were sharing a table and having dinner together. Unfortunately, I have forgotten their names, but I'll never forget their story. They had sailed over from Los Angeles and were spending 4 months roaming the South Sea Islands. What, I asked, did they do that aloud for such a thing? Turns out this guy had 2 partners and the 3 of them owned 2 things together, that sailboat and a business in LA. On a rotating basis, 2 would be in LA running the business while the 3rd would be out playing with the boat. Clearly you'd need partners you trusted implicitly, but with that in place. This might be the sweetest deal I've come across. These guys, along with Mook, are great examples of living boldly. While rare, they are not alone. Over the years I've come across any number of people embracing life on their own terms. They are intent on breaking the shackles of debt, consumerism and limiting mindsets, and living free. They are filled with ideas and courage. This freedom, to me, is the single most valuable thing money can buy, and it's why I offer you the strategies in this book. Chapter 35. Some final thoughts on risk. If you decide to pursue financial freedom, you are going to have to choose to spend your money on investments. Somehow in our culture this has come to be seen by most people as deprivation. That has never made much sense to me. Personally, there is nothing I'd rather buy or own than FU money. With it, the world's possibilities are endless and you are faced with the delicious decision as to what to do with your freedom. The only limits are your imagination and your fears. But while it might not entail deprivation, investing does mean taking on risk. The investing approach in this book is based on the premise that the stock market always goes up. After all, the Dow Jones Industrial Average started the last century at 68 and ended at 11,497. That was through 2 world wars, a deflationary depression, bouts of high inflation and countless smaller wars and fiscal disasters. If you want to be a successful investor in this current century, you need some perspective. Some seek absolute security, but it simply doesn't exist. Can I be sure the US economy is not about to enter the 25-year down cycle Japan is still living through? Or something worse? Nope. Is a 4% withdrawal rate always going to be safe? Nope. About 4% of the time it will come up short and you'll need to adjust. What about asteroids or supervolcanoes or viruses or alien invaders or an ice age or the reversal of the magnetic poles or AI robots or nanobots or maybe zombies taking us out? Relax. It ain't gonna happen. At least not on our watch. The Earth's been around for some 4.5 billion years. Multicelled life has been running around for about 500 million years or so. Major Armageddon extinction events, like the asteroid that took out the dinosaurs some 65 million years ago, have happened about 5 times. So that's about 1 every 100 million years or so. Are we really arrogant enough to think it's going to happen and the geological eye blink will be around? That will be the ones to witness it. Not likely. And if I'm wrong? If any of these life, or even civilization, ending events take place, how we are invested will matter not a single whit. This is not to say we face no risks. If you have money you have risk. You don't get to choose not to have risk, you only get to choose what kind. Consider. Stocks are considered very risky, and they are certainly volatile in the short term. But go out 5 to 10 years and the odds strongly favor handsome returns. Go out 20 years and you are virtually guaranteed to be made wealthier in owning them. At least if the last 120 tumultuous years are any guide. Cash is considered very safe. But every day its spending power is eroded by inflation. Over a few years, this is no big deal and cash is absolutely where you want to keep any money you plan to spend in the short term. But go out 10-20 plus years and it is a very big deal, an almost guaranteed loser. Perhaps it is more useful to think not in terms of risk, but rather volatility. Stocks have far more volatility than cash and in return provide far more wealth building potential. Cash has little volatility, but you pay for that in the slow erosion of its spending power. To answer, which is best, you must first answer, what are your needs, psychology and goals? We all must play the odds and make our decisions based on the alternatives. But in doing so we must also realize that fear and risk are often overblown, and understand that letting our fear control us carries its own set of risks. Getting past my own fears has allowed me to avoid panic and ride out financial disasters like the one that occurred in 2008. It has given me my own FU money. It has allowed me to indulge in my own somewhat risky passions. This book is designed to help you do the same. Having come this far, you now have a solid understanding of how investing really works and how to realistically build your wealth. You also now understand that the road can be rocky and that plunges in the market are normal. Armed with this knowledge, such events begin to lose their power to create fear in you, allowing you to avoid panic and stay focused on your goal of building wealth and achieving financial freedom. The path is before you. You need only take the first step and begin. Enjoy your journey.